sure who's scheduled to go to State of the State during the meeting which she chairs, but it is what it is. So you've got me again. So Happy New Year to everyone. Welcome back from the break. And I will turn it over to Carrie to call the roll and establish a quorum.
Thank you, Madam Vice Chair. And before I call roll, if I could just remind participants, *6 will mute your phone and *7 will unmute it. So I will start roll. Commissioner Garcia Richard.
Here.
Treasurer Eichenberg.
Present.
Secretary Romero.
Present.
Peter Frank.
I'm here.
Tim Jennings. Harold Lavender.
Here.
Lee Rawson.
Present.
Mike Messina.
Here.
Thank you. And Nick Tejas.
Here.
You do have a quorum.
Great. Thank you so much, Carrie. And thank you all for being here telephonically. We are meeting, the SIC is meeting virtually because of the statewide order on gatherings, but you can view these proceedings on the SIC channel on YouTube. So with that, if I could get a motion to approve the agenda as it is before us today.
So move, Harold. Second, Tim.
Thank you. We've got a motion to approve the agenda from Member Lavender and a second from Member Jennings. And I just want to remind folks, every vote that we take telephonically is going to be a roll call vote. And so if Carrie could call the roll on the approval of the agenda vote.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
And Nick Tejas.
Yes.
A unanimous, that would be 9-0 today.
Okay. Thank you very much. And next we're going to move to agenda item 1C. Do I have a motion to approve the minutes that were sent out for our November 24th meeting?
So move, Harold.
Okay, I have a motion by Member Lavender. Second by Romero, please. Okay, and a second by Member Romero. Thank you, Madam Secretary. So we are once again going to take a roll call vote on a motion to approve our November 24th SIC 6.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Harold Lavender.
Yes.
Lee Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
And Nick Tejas.
Yes.
Again, a unanimous 9-0 approval.
Okay, thank you very much. Agenda item 2, the State Investment Officer and Chief Investment Officer briefing. We're going to start with the SIO report by Mr. Moe.
Thank you, Commissioner, and good morning, everyone. Beginning with the traditional opening comments, the current net asset value is $31,744,000,000. Over the past 12 months, the funds have distributed to the state $1,045,000,000. West Texas Intermediate Oil is at $52.87 per barrel. The New Mexico Intermediate price as of January 22nd was $48.82. And as we look at rig counts in New Mexico, as of January 2020, 106 rigs were operating, and as of the 22nd of this month, we had 65 operating rigs. Just touching on a few of the items on the page I've sent you with my briefing. Item number B4 is the tax stabilization reserve. Just want you to note that the balance as of the end of the calendar year was $1,768,000,000. You have investment performance there. Vince will comment on that and may give you some more current readings on that, which we did not have at the time we sent this out. Looking at operations, item D. I'm going to wait and ask Vince to introduce our new fixed income director. We are in the process of hiring someone to help us with communications, and we'll have more for you on that as soon as that hiring is approved. Under item E, external relations, several things to talk about here. The New Mexico Recovery Fund. We had a thorough conversation with Sun Mountain Capital on Friday, and just to touch on the highlights, 22 loans have been funded from the Recovery Fund for a total of $64 million. The funds were used in the following cities: Albuquerque, Santa Fe, Las Cruces, Taos, Rio Rancho, and Farmington. Three things to point out on the industry breakdown. The majority of those loans went to accommodations and food services, 48.3%. Next were mining, quarrying, and oil and gas extraction, 13.6%. And the third highest number went to manufacturing, 11.6%. There are about 10 million in the legal pipeline being processed, which would bring the total up to about $73 million. I'm going to ask Charlie to comment on the Small Business Recovery Act updates. We'll wait just a moment for that because we have a couple of new bills pending that affect those dollars. I'll also ask Charlie here in just a moment to comment on the other things that we have pending that relate to the permanent funds legislatively. We have a new legislative briefing planned for the morning of February 10th. Our budget hearing before House Appropriations and Finance will occur tomorrow, and Brent may want to comment on that. We'll leave that to you, Brent. Each of you in your materials received something in a different format from that which you've seen in the past. We've titled it the SIC-2020. This is a retro. It is a look back at what you, the council, have accomplished during the previous calendar year. I think you'll find it interesting. If you have any comments on it or thoughts as to how we can improve it, please let me know. At 12:30, the governor will be delivering the State of the State message, and it can be accessed on the legislative website. Charlie, would you please comment on the Small Business Recovery Act as well as other legislative matters?
Sure. Thank you, Steve. Members of the council. So this is Charles Wallman, Director of Communications and Legislative Matters for the council. We're still in kind of early days of the session, so I'll try to be brief. Staff has thus received 3 requests for fiscal impact reports, bills that have been introduced so far. We're going to continue to pass those along to you, the council, in our weekly reporting. The first bill was HGR 1. This is the constitutional amendment seeking an additional 1% to be drawn down from the land grant fund for early childhood programs. SGR 1, Senate Joint Resolution 1, is another one of these bills. It will give voters a chance to approve whether to take an additional 1% distribution from the school permanent fund. That is the largest component of the land grant fund, and that money would be used to pay for teacher raises and instructional costs. Senate Bill 3 restructures the New Mexico Recovery Act, Steve mentioned, increasing the $400 million allocation approved by the legislature during the special session last summer to $500 million. It also lessens some of the restrictions as to who can access those low-cost small business loans and how they would be paid back to the severance tax fund. The program last year, as you might recall, managed to deliver about 760 loans to New Mexico businesses with a total of just under 40 million. That program is run by the New Mexico Finance Authority. There's a competing bill we haven't gotten a request on yet, but that's House Bill 11. It would also seek to repurpose those severance tax dollars. We'll have more on that in the coming weeks. One other thing I wanted to bring to your attention, late last Friday afternoon, proponents of a concept to create a new state bank asked that we provide the council an updated copy of their proposal, which staff shared with you back in December. This new state bank would have a 12-person board with banking and economic development experience appointed by the legislature and the governor. It would be funded by $50 million from the severance tax permanent fund, and it would also require that the state treasurer custodian about $50 million of state dollars with the bank, as well as all of New Mexico Finance Authority's operations. I'll be sending out that draft and some notes later today. If you have input that you'd like to provide to staff regarding that bill, either supporting or if you have concerns that you would like noted in a bill analysis, please let us know. We understand that the bill is going to be introduced by Senator Jeff Steinborn and Representative Patricia Roybal Caballero later this week. Should you have any questions about legislation this session, please reach out to me and I'll be glad to discuss. Madam Chair and Steve.
Thank you, Charlie and Commissioner. That concludes the State Investment Officer's briefing.
Do we have questions from council? Thank you, Mr. Rowley. Next, we're going to go to agenda item 2B. It is the Chief Investment Officer report, Mr. Smith. And then if you would just hand it over to RVK for the performance report after that, that'd be great. Thank you.
I'll do just that. Thank you, Madam Chair. Good morning, everybody. Glad to be back with you today. Let me first introduce you to Keith Sable, who joined the investment team on January 9th of this year as fixed income director. Keith joins Starla Bennett, David Lee, and Paul Chapman, who form our asset class directors group. These pros join with our consultants to do the demanding work of identifying and performing the due diligence, documenting, and ultimately bringing forward the investment, the individual investments to the committee and council. It's work that requires significant institutional investment experience, good investment judgment, and requires a difficult to obtain skill set, and we think Keith brings these things with him. So I'm very pleased to again have a full asset class directors group, and in particular to have Keith join us. I wish we could do this introduction in person, but Keith is on the phone with us today. Keith, would you like to say a few words?
Sure. Thank you, Vince, for the kind introduction. Madam Chair, I moved to New Mexico in 2005 and have raised my family here. For me, I find New Mexico is home. I'm proud of the great resource that the permanent funds represent for current and future generations of New Mexico. And for me, it's an honor that Steve and Vince have invited me to join the team of world-class investors charged with their stewardship. I look forward to working with all of you.
Well, let me welcome you, Mr. Sable, and we look forward to meeting you in person.
Thank you.
Okay, well, thanks, Keith. Okay, well, we've got an active agenda for you today. 3 new investments, one with a new manager and 2 managers with whom you're familiar. We've got some policy work to do in the area of benchmarking and a contract extension with the manager who's quite familiar with you, or familiar to you. Of these investments, Cerberus Real Estate Debt Fund is sponsored by Cerberus, which is a large global real estate manager with assets under management exceeding $30 billion. This will be a new manager in our stable. The fund will become part of the non-core fixed income investment portfolio. As you recall, the non-core fixed income asset class was increased to 15% from about 7 or 8% in the 2017 asset allocation study for land grant severance. And a number of our other funds, including client funds, have exposure to this asset class. We've been steadily pacing our way toward the target allocation since then, and Cerberus is part of that effort. Mikhail Kuznetsov will present the investment team's recommendation, and consultant Axia will cover their work and introduce the manager to you. Ares European Property Enhancement Partners 3 is sponsored by a manager with whom you're familiar and will become part of the real estate investment portfolio. The real estate portfolio is allocated at 12% of the land grant and severance tax, and several other of our funds under management, including a client fund, have exposure to the asset class also. From a portfolio perspective, this investment is part of the annual pacing requirement to maintain the real estate allocations, and it will help in our strategic move of reducing the core real estate percentage of the total real estate portfolio and increasing the non-core component. Real estate and real return director Paul Chapman will present the investment team's recommendation. Consultant Townsend is on the phone to present their work and reintroduce this manager to you. Jmi Equity Fund 10 is sponsored by a manager you're familiar with and will become part of the private equity allocation. Land grant has an 11% allocation to private equity, and severance tax is a 12% allocation to this asset class. Private equity director David Lee will present the investment team's recommendation, and consultant Mercer's on the phone to present their work and reintroduce the manager. Following that, we'll get into the benchmarking review. RVK will do the heavy lifting here for you in terms of presentation. This is an important investment policy item, so I hope you find the work that staff and RVK have done with this to your satisfaction, and also find the topic in general interesting as policy work. Lastly, I'll cover a contract renewal for a manager in the fixed income portfolio. On the macro front, things generally continue to unfold in line with our previous expectations and discussions with the council. Fourth quarter GDP here looks like it should be in the 4 or 5% range on an annualized basis. We could see little or no growth, maybe even a small negative here in the first quarter, but we're still expecting growth to return and become a little more stable in the second or third quarter of the year. There'll be much more on this in terms of our macro expectations, the investment implications, and some of the strategies that we currently have in place, and new strategies we may want to start moving toward. Beginning in March of this year, we'll try to nail down all the macro things that you're accustomed to: the annual investment plan, the new long-term capital market assumptions, our strategies and other things, portfolio structure in the May through June timeframe. So I'm looking forward to presenting that work. We've been underway the last 6 months anyway, preparing that. So hope you'll find it interesting and informative and helpful in the decision making around the portfolio. With that, Madam Chair, let me stop there and answer questions. And if none, or after that discussion, we'll just turn it right over to RVK for the investment performance.
Actually, before you do that, Vince, I'm wondering if you could give us some comments on the impact of the halting of federal leases on New Mexico. What are your thoughts there?
Yeah, I defer right back to you, Madam Chair, in the land office. That news just came out a couple of days ago. We haven't had particular, time thinking through. It looks like in terms run. The pipelines stoppage is an immediate impact. But the numbers around that's still kind of fuzzy. We're hearing several different numbers. So happy to share any thoughts that we do have. Paul and I haven't talked yet, in that area. But when we do, and if we come to any particular conclusions, we're happy to share that with you in your office.
I'd appreciate that, to the extent that it impacts, New Mexico is heavily reliant on this industry, and there's a lot of federal land here, but to the extent that it impacts my office particularly, we just are very uncertain moving forward about development on state land, because a lot of it is, compulsory pooled. There's a lot of units that involve both state and federal land, so we're just not quite sure how that's going to impact us at this point. But it is something that we are definitely watching and is concerning.
Yeah, we're happy to partner with you on thinking it through, down the line, and we'll certainly contact you.
Let me just ask, if there are other questions for Vince before we
Yeah, sir, just one thing you should note, the 17 western states, everybody on the east side of that, of the 17 western states, they don't have federal land like we do. And if you look at the federalism papers, it might be a good chance at this time to demand that we get the federal lands back into state ownership, and it would fund the state at least $1 billion more, at least that much, just from oil and gas revenues alone, where we share with the federal government. The other eastern states don't have this stuff. It's just something that Congress did to the western states, and it's not authorized under the Constitution, in my opinion. A lot of money for our people.
I have a question. Well, I'm not sure state control of federal lands is exactly the answer, but I do appreciate the thought. Who is that?
Who's
Mike
Tim?
Messina, I had a question.
Yes, Member Messina.
That maybe Tim can help me out with. Who in the state would have the authority to make that request, Tim? Do you know?
Well, I think the Attorney General or somebody could file a state, or the legislature could file it, but file a lawsuit about demanding the ownership of the states. The state gets $1 billion, gets half our oil and gas income. Why should the federal government get that? They don't do that to anybody else.
Well, I like the idea, Tim, but I don't like the idea of doing it through a lawsuit. That is not going to happen quickly, and there must be a more negotiable way of getting there. But thank you for that suggestion. I think it's really right on.
You got the most favorable Supreme Court we'll ever have to do that on states' rights.
Well, but it's going to take years to get there. I don't see it as a solution, but I like the underlying point you're making very much.
I'll be quiet.
Any other questions for Vince before we move to RVK's performance report? All right, back to you, Vince.
Thank you, Madam Chair. And from RVK, you have Marcia Beard and Matthias Bauer on the line. In your packet, you have both a November flash and we have a December preliminary flash. I'm just going to make a couple comments about the market, including November, and then we'll just briefly talk about performance, since these are preliminary numbers. After some declines in markets in September and October, global equity markets really bounced back sharply in November. Developed markets, both in the U.S. and outside the U.S., had double-digit returns, and emerging markets just for the month of November was up just over 9%. At that point, value shift in the market, value outperformed growth, and small cap beat large cap. And also the bond market was positive, just under 1%. Move to December, we continue to see it was a strong month for global equity, with returns in the mid to high single digits. The small continued to outperform large. And it's worth noting that the S&P ended at an all-time high for the calendar year, up 18.4% for the past year. Also, bonds ended the year positive, 1-year return of over 7.5%. Oil, as you well know, was up for the year. On the as of December, the 10-year Treasury increased only slightly, but just a reminder that it had dropped 100 points from where it was. The yield, 10-year yield was at the end of December of 2019, and that was down, and then it's down 176 basis points from where it was at the end of 2018. So strong equity markets for the last couple of months. You see that reflected in the numbers on your book, page 21, page 2 of the R&K report. We don't have the information necessary to break out by fund, so you can see not applicable for land grant, but when we look at the total New Mexico total fund, for the month of December, you were up over 3.4%. For the quarter, up over 8%, and on a fiscal year-to-date basis, up over 13%, and then that calendar year return of 8.65, and that's reflected down below where you can see the year where you began the year at $27.4 billion and ended the year over almost $30.8 billion. So strong performance. Ending the year. If you go to the next page, you can see the composite performance. And again, I want to point out this is preliminary, not for the traditional asset classes, but for the private asset classes. So again, that fiscal year to date is 13.3%. Global equity composite for fiscal year was up just under 25%, and on a calendar year basis, up over 14%. Looking down below at U.S. versus non-U.S., you see a rebound in the non-U.S. Performance where it has been trailing significantly prior, but had a nice comeback this year. So on a fiscal year-to-date basis of both U.S. and non-U.S. equities, around 25%, which is just mind-boggling. You can see some slight outperformance from your non-U.S. restructured your U.S. equity composite, restructuring non-U.S. On the fixed income side, strong outperformance for the core portfolio. Non-core, again, there are some privates in there, and remember that benchmark is lagged, but up 9%. Might be trailing the benchmark there, but the non-core certainly outperformed the core fixed income. If we go to the next page, you can see other asset class composites again, either showing zero or their preliminary performance. I would say, with the exception of down below where we show the financial return composite, that's actual, and that's a small piece of the portfolio, just over 1%. Mostly MLPs, and we saw a strong rebound in MLPs. So preliminary performance, but you can see that fiscal year looking quite strong, and you had a strong calendar year, even on a preliminary basis. Any questions? Questions from the committee? Thank you. Does that complete this item? Yeah, I'm sorry. That's just the summary on the preliminary numbers for December. We will answer any questions that you might have. Any questions from council? And you have November to do yet? I was just wrapping November in. can certainly look at it. I was just focusing on December, which includes the November numbers, but it's taking a look at November, which begins on page, I would say page 39 of your book. You see the strong performance for the month of November. You were up over 5.5% in November. At that point, your fiscal year to date was over 9.5%. So you see, December was strong, but now your fiscal year to date is over 13%. So a strong couple months for you.
All right, any questions from council on the performance reports before we move on? All right, thank you very much, Marcia.
Thank you, Madam Chair.
Okay, we're going to move next to agenda item 3, investment matters, and we are going to turn it over to, I guess, the acting chair of the CIC, Member Lavender, to give us the investment committee report.
Good morning, everyone. We had a really good meeting on last 2 Thursdays ago, and what I really wanted to do is to simply say that Vince has covered the majority of the items that we're going to cover today. They'll be covered in the following items. But I really want to say how much I appreciate the fact that Tim Jennings, Debbie, Nick, Sunlay Stewart for a little while, and then Stephanie joined us for our investment committee meeting. And it's a really positive thing when so many council members can join and listen in and be a part of that particular part of what we do. So I want to thank you for that. Other than that, we, as Vince has covered, we have 5 voting items for today, and 3 investments and 2 that are more administrative. And I think that having said that, I think it's important to move on and turn this right over to Vince.
Thank you, Member Lavender. Any questions on the investment committee report? All right, so with that, we're going to move to our first voting item on our investments. That is agenda item 3B, a vote on a fixed income investment. And what I'm going to do, Vince, is have you and your staff present, turn it over to Axia, and then if we've got anyone representing from Cerberus, then you can turn it over to them at that time. And then we'll take questions from council after.
That sounds like a great plan. Thanks. Let me just turn right over to Mahal, because Kuznet's on. Mahal did a great deal of work on this investment, along with the consultant and myself. And so we've got him queued up to present the staff recommendation.
Thank you, Vince, and good morning, everyone. On the line with us are Jennifer Wildman and her team at Axia, as well as Glenn Abbott and Neha Santiago from Cerberus Real Estate team. New Mexico State Investment Council would like to recommend the commitment of $125 million to Cerberus Real Estate Debt Fund. As Vince mentioned at the beginning, Cerberus is a global investment management firm with 800 employees, $50 billion in assets under management, and about 28-year track record. Real Estate Debt Fund will invest in institutional quality real estate, primarily in North America and Western Europe. Its strong real estate platform is used to maximize the downside protection while capturing attractive risk-adjusted returns across global private and public real estate debt sectors. Real Estate Debt Fund will be invested in a number of strategies, including but not limited to mezzanine debt, CMBS, rescue financing, and secondary loan transactions. Also, 50% of the target strategy is projected to be allocated to senior loans. From the portfolio construction perspective, New Mexico SIC does really appreciate funds diversification, not only by sector and capital structure, but by geography as well. The fund targets a gross IRR of between 10 and 13%, and that combined with the strategy's focus on downside protection, its limited correlation to public markets, flexible investment approach, and team's experience and expertise make real estate debt fund a great addition to the lending strategy's sub-allocation of the non-core fixed income portfolio. And with that, let me turn it over to Jennifer and Axia team.
Thank you, Mihail. Good morning to the council. Thank you for having me here this morning. As you know, we look to diversify the non-core fixed income portfolio, mainly to reduce the focus on corporate credit in the past few years by adding more asset-based debt. We've done a good bit in infrastructure debt, which is somewhat of a more steady state asset. Real estate, however, offers a bit more upside. And in this fund, in particular, this has the flexibility and expertise to take advantage of the current environment. And this is also a unique case where we find that the fund has already put a good amount of capital to work, insight and transparency into the portfolio and performance that New Mexico State Investment Council will participate in with your commitment. In addition, Cerberus is offering competitive fees relative to peers. And finally, big picture, Cerberus real estate debt will be included in the lending sub-allocation. Lending is presently the lowest allocation that you have for non-core fixed income in terms of invested capital, as these strategies really have tended to draw capital at a more measured pace than some of the other allocations, such as distressed and structured. So it's a good place really to add and bring invested capital closer to the long-term target range. And I have with me Erin Nessel to present Axia's due diligence findings and considerations.
Hi everyone, this is
Erin
Nessel. Great. Yep. Nice to speak with you all. So we conducted a full investment and operational review of Cerberus Real Estate Debt Fund, which is the first vintage of Cerberus's dedicated real estate debt program. Our due diligence initially took place in December 2018 prior to the launch of the fund, but we have stayed in close contact with Cerberus and closely monitored the development of the fund and the capital raised since. I will give you a brief overview of the fund and our findings. As previously mentioned, Cerberus is a global investment research firm founded in 1992. The origin of Cerberus's real estate platform dates back to 2004, when they launched the first of a series of opportunistic real estate funds. They are now in their fifth vintage of the opportunistic fund, which focuses on real estate equity, distressed debt, and special situations. Cerberus also launched a CMBS fund in 2013. And following that, they launched the real estate debt fund in 2019 that set out to invest in liquid and illiquid assets with more of a focus on performing debt than the opportunistic funds. At launch, the fund was expected to be co-managed by Cerberus's real estate and CMBS teams, but they have since added additional dedicated resources, including Neha Santiago, who is on the call today. In total, Cerberus has over 70 people focused on real estate globally across the platform. As Mikhail mentioned, the fund has a flexible mandate to invest in commercial real estate debt across the US and Europe, though it's expected to be focused on the US. The flexible strategy really allowed the fund to take advantage of a multitude of opportunities post-COVID. The initial focus of the portfolio was on commercial mortgage-backed securities during the dislocation in liquid securities that occurred in March and April. However, the primary strategy going forward is expected to focus on originating transitional commercial real estate loans in primary and secondary markets. The fund has raised $460 million to date of a target $750 million capital raise. The fund has deployed approximately $270 million of assets and $90 million of equity, which was all deployed in the post-COVID environment, which is notable. As of the end of September, the fund was tracking to a gross return on equity of about 21%. The investment period of the fund is 3 years. The harvest period is 5 years. Standard fees are 1.25% management fee and 15% carry over a 6% hurdle. However, New Mexico will be paying discounted management fees of 1.075%. In terms of what we like about the fund, I think the key merit here is the size and scale of the Cerberus platform. The fund benefits from a large team, strong sourcing capabilities, and with being part of a big platform like Cerberus, they should be able to secure more attractive financing terms and execution relative to a standalone platform. Secondly, we think the broad opportunity set in commercial real estate as a result of COVID favors a flexible strategy like this fund that can shift according to the opportunity set. Cerberus is one of only a handful of real estate debt managers with capabilities across a variety of asset types and markets. As we mentioned, we believe the fund has built up an attractive portfolio of post-COVID investments that new investors like New Mexico will benefit from on day one. And lastly, New Mexico is getting attractive fees that are competitive to opportunistic real estate debt funds and the broader market. We would note that this is a first-time strategy, and given that there is no historical portfolio, and given that the mandate is quite flexible, ultimate construction of the portfolio is somewhat uncertain. That said, we believe Cerberus's experience and strong track record in the opportunistic equity funds lend credibility to their ability to manage a new strategy. In addition, the current portfolio and the build out of the team certainly show proof of concept for the strategy. So overall, we've been able to get comfortable. And we do believe that Cerberus is well equipped to take advantage of an attractive opportunity set. I will stop there and see if anyone has any questions. Otherwise, I believe we'll pass it off to Cerberus.
Yeah, I think that's what we're going to do at this time.
Okay, great. First, I want to say thanks to the staff and investment council for your attention and consideration today. My name is Glenn Abbott. I joined Cerberus in 2008, currently serve in a managing director role within our real estate capital formation team. My coverage is the Western region, which includes SIC. If you'll join me on page 4 of the Cerberus presentation, I can take you through the fund and fundraise. Today, we're presenting our flagship fund series for value-added real estate debt. That's the Cerberus Real Estate Debt Fund. As Aaron mentioned, this is the maiden vintage. The fund is a closed-end commitment fund structure that employs a multi-strategy approach. We believe that's the best way to capture risk-adjusted return across global debt sectors and across market cycles. This is not a loan-to-own strategy. We are lending to institutional quality real estate and sponsorship, and our goal is really to advance relationships with our top-tier sponsors and get repaid principal and have principal repaid at maturity. We're targeting a 10 to 13 gross IRR. We're off to a really great start, and I'll put some numbers to that as we conclude today. On the fundraise, we're targeting commitments of $750 million. We had a first close of October 2019. Commitments to date are $460 million, and we've accepted $430 million of that to comply with the ERISA guidelines. Majority of our commitments have come from U.S. plans like SIC for use in their non-core fixed income and credit portfolios. If you'll join me on page 5 of the Cerberus presentation, I can take you through the Cerberus platform and our real estate platform. So Cerberus was founded in 1992. Currently, we're managing about $45 billion in assets across 3 core strategies. That's global credit, private equity, and real estate. Our real estate platform was founded in 1993. Since then, we've deployed more than $40 billion across global real estate debt and equity sectors. Currently, we're managing almost $12 billion in assets in the following strategies. In debt, we invest in direct lending, CMBS, and non-performing loans. In equity, we invest in direct assets and platforms. Taken several decades to build a comprehensive and collaborative real estate platform, and the shared knowledge that is generated is a key competitive advantage for this fund. Our real estate team consists of more than 70 investment professionals globally in a dedicated capacity, and they are led by a small and deeply experienced management team. Neha Santiago, who joins me today, runs our real estate direct lending business. Neha joined us from Goldman Sachs as a managing director in the spring and she has 16 years of principal investing experience in real estate, debt, and equity sectors. Now I'll hand it off to Neha.
Thank you, Glenn, and good morning, everyone. If you want to join me on slide 7 of the Cerberus presentation. Since joining the firm in May, I've built out a team of talented and experienced investment professionals dedicated to the new debt fund. Our senior originators, Punkil and Ali, have a combined 25 years of investment experience in the transitional loan origination space, and both bring a deep Rolodex of direct sponsor relationships with them. Punkil and Ali are supported by 4 VPs and associates who all came from reputable lending platforms, including Goldman Sachs and PGT Partners. In addition to the dedicated team, we are heavily supported by the investment professionals and the infrastructure across the broader real estate platform at Cerberus. Moving on to slide 8. As far as our competitive advantage goes, our greatest strength is the fact that we have no pre-COVID exposure. We did not deploy a first dollar of capital until this past April, when the market started to experience distress as a result of COVID. Not having pre-COVID exposure allows us to objectively evaluate the opportunity set without weighing our investment decisions against any troubled legacy positions. Our second greatest advantage, and frankly one of the draws for me when I was evaluating this opportunity, is our ability to leverage the broader real estate platform within Cerberus. We are able to leverage our existing portfolio to inform our diligence and underwriting decisions, which not only gives us access to real-time data, but it also gives us speed in the process and provides us with a high degree of credibility as a first-time fund bidding on competitive deals. In addition to the relationships that Punkil, Ali, and myself all bring with us, we are also able to tap into the firm's existing sponsor relationships. From an investment strategy perspective, we expect the bulk of our portfolio to be focused on the senior transitional lending space. These are loans that are typically short-term in nature and provide a bridge to stabilization. We expect senior transitional and sub-debt originations to account for at least 65% of the total portfolio. As you are all aware, we've been active in the CMBS space and continue to monitor the market on a daily basis to source new opportunities with the support of our dedicated CMBS team. The remaining allocation of the portfolio we reserve for what we bucket as opportunistic and market-driven opportunities consistent with our flexible investing approach. Buying performing loans at a discount to par and providing rescue capital are 2 examples of areas we currently find compelling. Slides 11 through 13 focus on the fund strategy. The fund strategy was conceived pre-COVID, and the opportunity set was really driven by the significant wall of maturities expected in both the US and Europe over the next 5 years. COVID has really amplified the opportunity set for transitional lending, as near-term refinancing requires short-term bridge loans as a bridge to stabilization, as business plans and cash flows have been heavily disrupted as a result of COVID across just about every asset class. If you flip to slide 10, you'll see that the opportunity set in this post-COVID environment is more attractive from a risk-return perspective as well. Last dollar attachment points are lower as lenders have pulled back on risk. Valuations are down as much as 30%, which means that we are lending at a very attractive basis, and spreads have widened out anywhere from 100 to 350 basis points, depending upon the underlying asset class. Negotiations have tipped back in the lender's favor, and we are also able to negotiate stronger and tighter loan covenants than where the market was pre-COVID. The deals that we have closed to date in our existing pipeline is geared towards taking advantage of the ability to get paid well on lower risk opportunities. 65% of our portfolio is comprised of industrial and multifamily, which have been the 2 most resilient asset classes in this market environment. We recently closed a deal in the self-storage space, which is an asset class we really like in a recessionary environment, as it tends to demonstrate counter-cyclical fundamentals. And we have also focused on limiting our exposure to construction risk. With that, I'll hand it back over to Glenn to walk through the fund's performance stats.
Thanks, Neha. If you join me on page 14 of the Cerberus presentation, we can close with some updated numbers. As of year end, the fund had called about 15% of its equity and generated an inception to date gross return of 55% by business day 5 marks. We're having a final close on March 1st, and by then we expect to be 35% invested based on target commitments. Projected yield on this portfolio is currently 15%, which exceeds the high end of our target return range. Going forward, we believe we're in a strong position to execute this strategy as the portfolio is well diversified, filled with high quality risk reward profiles, and as mentioned, has no legacy or pre-COVID investments to distract us. So again, thanks for your attention and consideration today. And with that, we're happy to open it up for questions.
Thank you, Mr. Abbott and Ms. Santiago, for being with us today. Now we're going to go to questions from council on this investment for either our staff, Axia, or the representatives of Cerberus. Questions from council. Are there any questions from council? All right. If there are none, we'll go to a motion from Acting Chair Lavender.
Thank you, Madam Chair, Vice Chair. Just to make it clear on this one as well as the other 4 recommendations, voting matters, Mike and I, after the review of each one, have recommended each of these for submission to and approval by the council. Based on the recommendations of the Council Investment Committee, Fixed Income Advisor, Axia, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve commitment of up to $125 million to Cerberus Real Estate Debt Fund, LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiations of final terms and conditions, and completion of appropriate paperwork.
Thank you, Member Lavender. Is there a second?
I'll second. It's Mike Messina.
Okay, we have a proper motion by Member Lavender and a second by Member Messina on the Cerberus real estate investment vote. And if we could have Carrie take a roll on this motion.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Harold Lavender.
Yes.
V. Rawson.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Nick Taya.
Yes.
A 9-0 unanimous decision. Chair.
Okay, thank you very much. And thanks to the folks from Cerberus for joining us today.
Thank you for having us.
All right, we'll move to our second voting item, investment voting item. That is a agenda item 3C. It's a real estate investment into Ares European Property Enhancement Partners 3. I will turn it over to our staff from the SIC, Mr. Chapman, the Asset Class Director, and then Paul, you can direct to Townsend, and then if we've got folks on the line from Ares.
Excellent. Thank you, Madam Chair. And good morning, everybody. This is Paul Chapman. On the phone, I've got Clay Camper and Nino Carpenito from the Real Estate Return staff, Jack Koch, Seth Marcus, Andrew Bradley from Townsend, and also on the line are Julie Solomon and Wilson Lamont from Ares, and we'll get to each of these groups in a couple of minutes here. Wilson is the person who's primarily responsible for directing the execution of the EPAP, which is what we call this Ares European Property Enhancement Partners strategy. So I think you should look forward to hearing from him. This morning, we're presenting a $75 million commitment to EPAP 3 for your consideration. It's a closed-end, commingled, value-add, pan-European real estate fund targeting a $1 billion fundraise. EPAP 3 will follow the predecessor fund strategy of acquiring cash-flowing properties in major European markets and enhancing value through active asset management. Initially, the primary focus will be on logistics and residential, and I think you just heard from the Cerberus folks that those are very popular and relatively safe asset classes in the real estate world right now. But the fund will also invest in office, mixed use, and retail as opportunities arise. I'll point out to the investment committee that New Mexico State Investment Council is already an investor in 2 of Ares European opportunistic funds, Ares European Real Estate Funds 4 and 5. Fund 5 is still very early in deployment, but Fund 4 has returned 90% of capital and projects a net IRR of 12%, in line with original targets. The key elements of EPEP 3 strategy are to seek distressed sellers, not distressed assets. This means buying assets of bankruptcy, recapitalizations, failed marketing processes, and acquiring from other closed-ends and funds that are nearing the end of their fund lives. The focus is on institutional quality income-producing assets. And they're looking, as they diligence these assets, for the availability to create value through 2 or 3 value creation levers. The fund targets a net IRR of 8 to 11.5%, with about a half of this return coming from cash flow. The fund seeks to achieve a net equity multiple of 1.4 to 1.5x. They've demonstrated the ability to achieve these returns in prior funds. EPEP 1 has a 21% projected net IRR, 1.5x multiple. EPEP 2, 15% projected net IRR, 1.4x multiple. As EPEP 3 nears the end of fundraising, the fund has already invested or is in closing on over 430 million euros of equity in 6 transactions, giving New Mexico State Investment Council good visibility into the portfolio and ability to execute the strategy. And I know that Seth, when I turn it over to him, is going to address a couple of assets that were acquired pre-COVID. As has previously been discussed with the investment committee, staff seeks to reduce exposure to core plus, which is currently 67% of our portfolio, and pivot more to non-core, which is our value add and opportunistic buckets. This goal is partly due to our desire to bring the core non-core allocation closer to the 55-45% weighting that council recommends, but also to take advantage of an attractive vintage arising out of distressed market conditions that are attributable to COVID. Those are my comments. I'm going to have Seth take it over from here.
Thanks, Paul. So this is Seth Marcus, and Happy New Year to everybody. It's been a couple months since we all spoke, but I will highlight some of the comments or elaborate some of the comments in our presentation or in our materials. As Paul highlights, we are recommending a $75 million commitment to Ares European Property Enhancement Fund 3. Like Paul, I'll refer to this as EPEP 3. This is the Ares European Value Add Fund strategy. So our portfolio, as Paul mentioned, has exposure to Ares through 2 opportunistic fund commitments, one made in 2014, the other in 2019. We also have exposure to Ares in the real return portfolio. We made a $75 million commitment in 2019 to their open-ended debt fund in the financial assets portfolio, and a $75 million commitment to their energy fund in 2019. Lastly, there's additional Ares exposure throughout the private equity portfolio. So it's a name that is throughout the New Mexico portfolio. As we approved a number of investments throughout the 4th quarter of last year, if this fund is approved today, it'll actually represent the 4th non-core commitment of 2021, totaling $325 million of non-core commitments. Given you're relatively familiar with the Ares name and the firm, and Paul talked a bit about the strategy, I'll really highlight some of the European, why Europe, and also some of our potential issues and concerns highlighted in our memo. So European real estate has experienced dislocation across the board, really over the past year. This is expected to continue over the next 12 to 18 months as the global economy slowly recovers. The dislocation and weakening of global economies has created really a need for liquidity for motivated sellers, creating the opportunity to acquire high-quality assets at discounted entry points. So Ares' strategy for this fund is to acquire those fundamentally good, high-quality assets at attractive prices in major European markets. Paul had mentioned this, but I'll say it again because it's important that Ares does expect about 40 to 50% of total returns to be generated from current income. So with the remainder coming from capital appreciation. Given an experienced team that has executed a similar strategy in similar market conditions following the global financial crisis, robust pipeline, and really access to significant dry powder through this fund, the strategy positions itself favorably to capitalize on the current market environment. As always, in our memos, we highlight a few potential issues and concerns, each of which we believe is well mitigated. The one I'll spend just a couple minutes talking about before handing over to Ares is the third one in our memo. It's labeled current global turmoil, and more specifically, the seed assets in the portfolio. I don't think I need to rehash where we are today from a global pandemic status, but it is important to highlight that the EPEP fund has been raising capital since early 2020. It'll have a final close later this quarter, at the end of the quarter. The fund has successfully closed on over $500 million with strong visibility to close on the full target of $1 billion. During this fundraising period, the fund actually acquired a number of assets that we highlighted in our memo, but a few also that are not included as they were recently closed as early as this month. So I think Ares will speak some more to those during their presentation. But the seed assets are really a combination of residential, logistics, and an office asset in UK, France, Germany, and Spain. The two investments we focused our time on were the assets acquired in late 2019, so obviously pre-COVID-19 pandemic. And this includes a residential investment in Germany as well as an office asset in France. So these combined investments are anticipated to represent approximately 10% of the fund, or $100 million. The first one, a German residential portfolio, this represents 64 million euros of fund equity, and this is invested across 135 properties, over 2,800 residential units. This investment has actually benefited from really an ongoing favorable supply-demand dynamics in German multifamily sector. Since ownership, the portfolio has experienced strong rent collections, a term we've all become familiar with over the last 9 months, of 95%. And resilient vacancy levels, just about 6.5% is vacant as of the last update. With 110 new leases were signed at really higher market rents than what they've seen. This has resulted in actually a valuation increase of about 3.8% due to the residential demand dynamics in Germany's lower borrowing costs. The second investment acquired pre-COVID was called W Tower. Is called W Tower. It's a Paris office tenant office tower in one of Europe's largest office districts. The asset 92% leased to 26 different tenants, and rent collections again here have been 100%. I'd also note that the 8% vacancy, so 92% leased, was a planned vacancy that Ares was aware of upon acquiring this asset, and it is already in discussions with potential tenants to release the space at a higher rent than the tenant that had departed. With that said, the investment has also experienced a small write-down in value, about 1.5% write-down. And this is more due to a conservative office rents being utilized by appraisers, a lower yield going forward, and generally just market uncertainty today. While we're still waiting on sort of year-end valuations, these two assets, as of September 2020, the total portfolio value increased 1 to 2%. And that's with the German residential investment, really that value increasing more than offsetting the slight reduction in the Paris office asset. So when we look at buying into a seed portfolio, we want to make sure that we're not buying into something that's going to be revalued to the downside, and that's not the case in this investment. Lastly, the additional pre-seeded assets that are held in this portfolio are held at cost. So given the recent acquisition, so we're buying these at acquisition value. These investments are in attractive sectors of logistics, industrial, as well as residential. The last comment I'll make is that in the Townsend recommendation, we highlight a fee break if Townsend clients aggregate 100 million euros in commitments. With New Mexico's commitment, we will achieve that fee break. So New Mexico's commitment will result in a 5 basis point fee reduction throughout the life of the fund. And I'll stop here, hand it over to Ares, and then happy to jump back in with any questions.
Great. Thank you, Seth, and thank you, Paul, and to all of you for having us today. It's a pleasure to be back with the council. And as we join by phone, I hope this finds you and your families all doing well and good health and safe. I'm Julie Solomon. I'm a partner in the real estate group at Ares. I've been with the real estate group for 15 years, working with my partner, Wilson Lamont, who is the co-head of Europe. He's joining us from London and has been with the real estate group for 18 years. We're excited to first thank you for all of your support over the years in our European real estate funds, as well as our real estate debt strategy. And by way of background on Ares European Property Enhancement Partners 3, allow me to highlight for you, this fund invests in cash flowing real estate across major European cities with a value add strategy that's implemented by a very high quality and experienced team that's been investing in the region for many years now. We're targeting €1 billion and have held a number of closings, attracting interest from a group of global institutional investors like yourselves, who have really focused in on our performance and the attractiveness of the seed portfolio. Many of you are familiar with Ares management. I will touch on a few key points. We ended our last quarter at $179 billion of AUM. We operate in 4 distinct yet highly complementary businesses in credit, private equity, real estate, and strategic initiatives where we enjoy a long relationship with the state of New Mexico. Our team at Ares is broad and deep, and many of us have worked together for a long time, including through several economic cycles. The firm is highly coordinated and collaborative, and as you can imagine, it makes it truly a privilege to work in such a culture. We share information, ideas, and market insights, and it flows across our platforms through our committee meetings, our town halls, and our working groups. And we have very flexible and nimble point-to-point contact, even in the environment that we're in today. This enabled Ares to navigate the early days of the crisis extraordinarily well, and now more than ever, we continue to rely on the collaborative culture that defines our firm. As we move through the presentation, you will see a page dedicated here to our ESG initiatives. We take great pride in a firm that extends our performance through the way we support our people, our communities, and the world around us. Ares has many ESG initiatives and practices in place, and our objective is to accelerate Ares' path to ESG leadership. We believe outperformance on these ESG factors creates value and mitigates risks for our investment, our investors, and for our community. Our head of ESG partners with each of our business systems to establish what is required for that individual business and the vehicles that we manage on behalf of our investors. As a company, we're committed to creating an organization that reflects the world around us, and we're taking meaningful steps within our communities and our business leaders to support and embrace ESG and all forms of diversity. Focusing in briefly on the Ares Real Estate Group, we manage just shy of $15 billion of AUM, led by 14 partners averaging 24 years of experience. We are investing across the major property types in the real estate industry, and we do that through equity and debt strategies. All of our vehicles are unified by 3 key principles, themes that you will always hear from us as we talk through our business, and that is we're led by a cycle-tested team that has generated results for our investors that have been compelling across market cycles. Through the relationship with our private equity and credit colleagues, we have access to real-time property, market, and corporate trends, and you will see overlaying all of our strategies a disciplined approach to value creation and risk mitigation. And that has left our portfolio in good health and strong formation since the onset of the pandemic, and has put us in a good position, a solid position to move forward. I'll now move it over and send the presentation to my colleague Wilson, who will walk you through our fund and strategy, beginning with what we believe is really one of the key differentiators for Ares, and that is the track record, the presence, the longevity, and the performance of our European real estate platform. Wilson?
Thank you, Julie. Good morning, everyone. Hopefully you can hear me okay as I dial in from London. Thank you again for inviting me to join your meeting this morning. I'm going to start on page 8 of the Ares presentation. And this is a slide that summarizes the evolution of our real estate business in Europe. And as you can see here, we've been doing business in Europe for 25 years. Our business has grown steadily and consistently through that period of time and through multiple market cycles and different market conditions. We've grown our footprint geographically across the large markets, and we've grown our product offering from our EF Fund series through to EPEP as well. In that time, we've done 175 different transactions, and that's given us great depth of experience and execution across the region in the major property types in which we invest and operate. Of course, this would not have been possible without what we believe to be an excellent team, and I'm now moving on to page 9. This is our team sheet for our European business, our European real estate business at Ares. Today we have 45 dedicated real estate professionals who have extensive local investment, asset management, and operational capabilities. As you can see from the names on this team sheet, our team reflects the fact that we are operating across the European countries. As I walk around our office, I hear most, if not all, the major European languages being spoken in our offices. That reflects the nature of our team and the countries that we operate in. Our team is multidisciplinary and covers all the functions that you'd expect of a full service platform, not just investment and asset management on the real estate side, but investor relations, legal, finance, tax, and compliance. We're very proud of the team, and it's one that has been very loyal and stable over a number of years. Moving now on to the next page in the Ares presentation, page 10, the EPEP fund series. And as has been touched on several occasions already, EPEP is our European Value Add Fund series. This fund acquires high quality income producing assets in the major property types in the major cities of Europe. As you can see from our track record, we have managed significant capital in this strategy since its inception in 2012. We are performing ahead of the key performance metrics that we measure ourselves against, and that's especially important today. And I would draw your attention to the fact that these numbers reflect the most recent asset valuations as of the 30th of September 2020. We've achieved consistency across our funds and co-investment, and as been talked about earlier, a key component part of this is the stable cash-on-cash yield that we generate that has been on average around 5% since the inception of these funds, and that's on a per annum basis. Moving now down to page 11 and looking forward to what this current market environment means for EPEP 3. And in short, we are extremely excited about the prospects for this fund and this vintage. Timing-wise, the fund will benefit from the start of a new property cycle in Europe, and we will have the ability to invest into what we hope will be a strong recovery. Today, we see dislocation and in certain circumstances distress building across the market as the effects of the pandemic wear on. Assets reprice and owners become weary and under stress. As we look at our pipeline today, it is longer, it's more attractive, it's more strategic than in many of the years prior to the outbreak of COVID. We think this plays into our cycle-tested all-weather strategy of buying fundamentally strong income-producing assets with 2 to 3 value enhancement opportunities that gives us optionality to the upside. So in short, we are excited as we move into this period, and we think we're very well positioned with EPEP to take advantage of the current market opportunity. Moving on to page 12, and to bring this to life in a little more detail, since the inception of the fund, we have talked about the types of owners that we like to buy assets from. And we have this expression that we like to buy from owners who have lost money, interest, or control of properties and of their properties. And Paul mentioned before that this fund seeks distress in the ownership, but does not seek to buy distressed properties. And that's the rule book that we'll be following moving forward. So when we look at the situations that are coming forward now that we can take advantage of, it's the similar situations that we saw in the years after the GFC. The ability to buy assets out of bankruptcy, the ability to provide rescue capital to distressed owners. It's funds at the end of their term where certainty of close is more important than price, and it's failed processes. We see all of these circumstances now coming forward in greater numbers as we move through the post-COVID market environment. So moving on to now page 13, portfolio construction. We have a very successful cycle-tested playbook that we followed very clearly in EPEP 1 and EPEP 2. We'll be doing the same in EPEP 3, where we will seek to make 10 to 15 investments in EPEP 3. This will ensure that we have sufficient diversification, while at the same time making sure every deal is meaningful to the overall performance of the fund. By asset type, we have now got clear winners and losers in the post-COVID market environment. We have consistently stuck to investing into property types that have strong, supportive structural tailwinds. And that will see us putting a significant proportion of the portfolio, investment portfolio, into the logistics and industrial and residential sectors, and to a lesser extent, mixed use and offices. By geography, we are targeting the major geographies of Europe, Germany, UK, and France, and that's where we see the pipeline today and the liquidity in the future. So in short, significant dislocation building in the European real estate markets where asset mispricing has been caused by COVID. We think the next couple of years will be a great vintage to invest into the European markets. We have an experienced and stable team, an excellent track record, and a strategy that's very well positioned to take advantage of the market recovery. So I'm going to pause there. Thank you again for your time and attention today, and we welcome any questions that you may have.
Thank you, Mr. Lamont and Ms. Solomon, for being with us today, as well as our folks at SIC and our consultants from Townsend. Just for folks listening in the public, the acronym EPEP stands for Ares European Partner Enhancement Partner 3, Fund 3. And it's I know folks who are listening in may have questions about the SIC seeking investment into European properties and not properties that are domestic or here in the States. So I'm wondering if the staff could just talk to how these investments are deliberated on and chosen, and why we seek these investments abroad. And Paul,
happy to do that.
A few words. Yes, thank you, Paul.
Yes, happy to do that, Madam Chair. So we do have investments outside of the U.S. I think, roughly speaking, and it depends if you're looking on a net asset value basis or a committed basis, but think about maybe 12 to 15% allocated to Europe and 5 to 8% allocated to Asia, again, depending on what metric you're using. We think this allows us to take advantage of opportunities in other sectors, but it also provides some diversification in our portfolio. So just by way of example, we have we have a Asian fund investment that it's a core investment strategy in real estate. But in the fourth quarter, because the U.S. dollar fell so rapidly, it produced really amazing returns, north of 7% in the quarter. So those returns protect the rest of the portfolio when other things may not be going as well. So we do seek a certain amount of diversification as we build out the portfolio. Does that address your question, Madam Chair?
Thank you very much, Paul. I wanted to give some context for folks who are listening in who may not have an idea of the full portfolio of the SIC and understand that the investments are not only based on their location but on their return and risk ratio as well. So I appreciate you talking about our diversified investments and giving a little bit of context. Thank you. With that, I'm going to open it up to questions from the council on this investment. Wow. All right. If we have no further questions from council members, I'm looking for a motion from Member Lavender.
Based on the recommendation of the Council Investment Committee, Real Estate Advisor Townsend, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve commitment of up to $75 million to Ares European Property Enhancement Partners 3, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Tim Jennings.
All right, we have a proper motion from Member Lavender and a second from Member Jennings on an up to $75 million investment into Ares European Property Enhancement Partners Fund 3. And with that, I will have Carrie call the roll on this vote.
Commissioner Garcia-Richard?
Yes.
Secretary Romero?
Yes.
Treasurer Eichenberg?
Yes.
Peter Frank?
Yes.
Harold Lavender?
Yes.
V. Rothman?
Yes.
Tim Jennings?
Yes.
Mike Messina?
Yes.
And Nick Tayet?
Yes.
Again, Madam Chair, a unanimous decision, 9-0.
Thank you very much, and we thank the Ares folks for being with us today.
Thank you. Have a good day.
Thank you.
Thank you. Thank you. Okay, we're going to move to agenda item 3D. It's a private equity investment into Jmi Equity Fund 10. And we'll turn it over to David Lee, who is our asset class director. And David, if you would then turn it over to the folks that you have joined.
Thank you, Madam Chair, and happy to. Good morning, Madam Chair and the Council. I want to introduce who is on the call, first of all. It's myself and Chris Cassidy on the staff. From Mercer, it would be Richard Pugmire and Amy Ridge, our usual consultants. And then from JMI, joining us would be Peter Aerosmith, who's Managing General Partner, and Lindsay Mehta, who is the Vice President of Investor Relations and Marketing. These materials, for reference, start on diligent page 175. I'll provide a brief summary and then turn it over to Mercer, and then we'll hear from JMI. This is JMI Fund 10, and as a reminder, JMI focuses on growing software investments. These are predominantly in North American companies with at least $10 million in revenue and that are either profitable or have a clear path to profitability. Some of the focus areas for JMI are HR and workforce management, IT and infrastructure, sales and marketing software, and application software in the education, healthcare, IT, and government fields. JMI looks to source opportunities in non-traditional technology markets to limit competition from other growth capital providers and has developed a database with more than 52,000 8,000 companies in 33 industry subsectors. The organization has 29 investment professionals, and they're located in 2 offices in Baltimore and in San Diego. And in addition, the Operational Excellence Group has 5 professionals, and there are also 9 consultants with functional expertise in product management, customer success, human resources, and sales and marketing. Fund 10 will have a target of 15 to 20 companies, and the investment check sizes will fall in the range of $25 million to $150 million. The target size of the fund would be $1.3 billion to $1.7 billion, with a general partner commitment of 4 to 5%. That's just above the size of JMI 9, which was $1.2 billion, and JMI 8, which was $1.3 billion. JMI's overall performance has been strong, with relative performance versus the Burgess North American, Expansion Capital, and Buyout Reverse in the first or second quartile on a TVPI, or total value to paid in capital basis. And that's for funds 6, 7, 8, and 9, the last 4 funds. And the DPIs, or distributions to paid in capital, have also been consistently in the first and second quartile for these funds. In addition, JMI has continued to emphasize limiting losses and capital preservation in companies that are performing below expectations. Along with very healthy software markets, the net effect has been lowered loss ratios and higher DPIs in the most recent funds. And that loss ratio has been below 10% since 2005. Thus, staff and consultants believe that JMI continues to be an excellent long-term partner and are recommending a commitment of up to $50 million in JMI Fund 10, and this would be the SIC's 3rd commitment to JMI, having previously committed $50 million in Fund 8 and $75 million in Fund 9. And with that, I will turn it over to Mercer for additional comments.
Thank you, David. As David mentioned, this is a re-up, as there's been $125 billion of previous commitments to JMI 8 and JMI 9. Both funds have generated a combined 21% net IRR and a net multiple of just under 1.5 times as of September 30th, 2020. And that equates to about $40 million gain for the SIC. In particular, Fund 8, which is a 2015 vintage year fund, the distributions to the SIC have been $58 million through January, which exceeds the amount you've contributed by about $12 million. So there's a lot of positives on multiple metrics here. As a reminder, even though the prior funds have done well, we do re-underwrite the fund as we would a new commitment, and you have our report that summarizes the results. We continue to be favorable about JMI and the fund. What we like is JMI has a team of 29 investment professionals led by 8 general partners. The team really has a long tenure of focusing on the software strategy, with 6 of the 8 general partners being at the firm for at least 12 years. The team's capacity to take on new investments has actually increased, with an average of 4 investments per general partner, driven by JMI being active sellers in this strong environment that we've been in. But we also like that they continue to improve the team with increased operating resources over the last 5 years that have been added to help add value to portfolio companies. JMI only focuses on this strategy, which has been consistently focused on software and technology. One component of the strategy that we like is they focus on investments outside of the well-known technology hubs in the country. It takes more work from a sourcing perspective, but they've been able to find strong performing companies in geographies that you might not think are technology hubs. To illustrate this too, New Mexico is actually a geography that they track as part of their strategy, and they have 65 companies currently in their database that they're tracking. Performance has been strong across all of its funds. None of the funds are below median on a net multiple basis, and many are in the top quartile. And 2020 was a strong year for JMI to sell companies. They've had really good discipline and not increasing the fund size significantly. given their track record and the demand for the fund, they could increase the size higher than where they are, but they've chosen to keep it smaller than some of the other technology funds that are out there. As part of the process too, we also looked at the firm's process regarding environmental, social, and governance issues, or ESG. From an ESG perspective, the firm has an ESG policy, and they review ESG implications as part of their due diligence process, and then they continue to do so post-investment, usually from being a board member on their portfolio companies. They do an annual ESG review where they'll identify any issues that need to be remedied at its portfolio companies, and then they'll report any concerns to limited partners, which you like to see that transparency. Just a couple areas of concern that I'll highlight. When you look at terms, one term that JMI hasn't had is a preferred return. And we've talked about this when we've presented it in the past. As a reminder, a preferred return is a term that where investors get distributions until a certain return is met. Then there's usually a catch-up so that the general partner receives 20% of the net profits. While it'd be nice to see that in the structure, there's a lot to like in the term structure. The fund has an all contributions first waterfall structure, which basically requires the firm to return all contributions used for investments and fees back to the SIC before taking any carried interest. And it's better than a deal-by-deal waterfall structure, which is still fairly common in the industry. They also have a large general partner commitment of close to 5%, which is higher than many funds in the market. One note on performance too, when you look at benchmarking, there are a couple of funds that are slightly below median on a net IRR basis. Investment pacing and longer hold periods can create drags on IRRs, but JMI has been able to generate strong multiples, which shows their ability to create value. I think one driver of the lower internal rate of returns in the past is JMI's approach of being selective at how they deploy capital. And one thing you've seen in the last 10 years is the strategy of quickly deploying capital has actually paid off since we've been in a growth environment. But we like JMI's approach of being more selective, feel that that could be more attractive if we end up in a more volatile environment going forward. And so I want to reiterate that we recommend a $50 million commitment. And with that, I'd like to introduce Peter Aerosmith, who's been at JMI since 1996, and beginning this year will be one of the two managing general partners of JMI. And he is joined by Lindsay Mehta, who is Vice President of Investor Relations and Marketing.
Richard, thank you. Good morning to Madam Chair and to the entire council. And thank you, David, and your team for the introduction. Again, this is Peter Aerosmith from JMI Equity. I'm one of the partners at the firm. I joined JMI in 1996 as an associate and have spent the vast majority of my career with JMI. I sit in our San Diego office. I wish I were with y'all in Santa Fe, but for the obvious unfortunate reasons, we're going to do this by phone. So thank you, everyone, for joining. Why don't we start on page 3, just to sort of recalibrate everybody. JMI Equity is a growth equity firm focused exclusively on the B2B software market. We've been in business for 28 years. We've made 150 investments and have had over 100 exits or liquidity events. We're proud of our strong track record, our disciplined and focused investment strategy, which has been the same since we started the firm, and our team, which has been working together at the VP level and above for over 10 years on average. Why don't we turn to page 4? Let's talk a little bit more about the team. So we have 9 investing general partners. Each of us will lead investments, sit on the boards of the companies we invest in, and help manage the business on a day-to-day basis. Supporting us, we have 20 investment professionals. They spend most of their time looking for new investments throughout North America. Historically, we've done that by getting on a lot of airplanes. This year, the last year or so, we've replaced that with a lot of Zoom calls. We have 5 operating team members. I'm super proud of this team we've built over the last decade. They spend 100% of their time working within our portfolio to try to make the portfolio company's performance as good as it can be while taking risk out of play. We have 16 professional staff. We're very proud of the work we do in reporting to our LPs and managing the back office of the fund. And then finally, we have 9 additional resources who also spend all their time in the portfolio working as functional area specialists. That could include sales or marketing or product development. Turning to page 5, we don't need to spend a lot of time on this, but we're super proud of our performance. The one number I'd point to is in the last couple of funds, 9 and 8, the loss ratios being below 5%. Our plan is to keep these below 5%, and it speaks to where we invest. We're not investing in super early stage companies. They're $10 million in revenue and above, as David mentioned. So we think we can achieve growth returns for our limited partners like New Mexico while taking significant risk out of play at the same time. Turning to page 6, let me spend 1 minute on the market we invest in. So business-to-business software is a really, really healthy market. So this market grows roughly 6% per year and has been doing so for the last 30 years. So that grows at more than twice the GDP. If you look at the light blue bar, the big move in the software industry in the last decade has been moving applications and software products to the cloud. So like online banking or Diligent, which it sounds like you all use, those applications are accessed through a browser. You can see that part of the market is growing even faster, and that's where we spend 100% of our time. So this is an extremely constructive market for us to participate in, one that's growing fast and highly predictable. I'm going to hand it over to my colleague, Lindsay, to talk about page 7.
Thanks, Peter, and thank you to the committee for the opportunity to present today. The numbers here on page 7 of the materials represent the key performance metrics of the JMI portfolio as of the end of 2020. The total portfolio of 30 companies representing $3.1 billion of value has grown revenue 30% on average over the past 3 years. Average revenue across the portfolio is currently $65 million, 85% of which is recurring. The portfolio also has high growth margins of 70% on average. And customer retention rates, which are an important metric for software businesses, have also held at 90% through 2020. On slides 8 and 9, Peter and I will talk a bit about return drivers as well as exit opportunities for JMI's companies. Looking here at slide 8, the majority of JMI returns come from growth, which accounts for 70% of realized gains over the past 5 years, with the remaining 30% coming from multiple expansion and then a small portion from debt paydown. Given our growth focus, we're not overly dependent on outsized multiples or credit markets to generate returns. And with that, I'll turn it back to Peter to talk more about the exit landscape on slide 9.
Thanks, Lindsay. So the key headline here is that our portfolio companies have very attractive exit options. So particularly in the last 5 years, financial sponsors or other investment firms have become active buyers of our portfolio companies. So you can see historically, companies like ours would have to rely on either being bought by a larger strategic or going public to get liquidity for our limited partners. Today, those two options both still exist, but other financial sponsors or other institutional investors have become very active buyers of our companies. It's now roughly 35% of our exits are coming from other financial sponsors. Strategics continue to be a very healthy exit environment for us, including, Google, Workday, Adobe, and Qualcomm, all very, very large tech companies. Our portfolio companies provide the big tech companies access to higher growth and innovation. Turning to page 10, I just thought I'd touch on a couple of aspects here. I think the key to our team, above all else, is that our partnership is young. So I've been at the firm almost 25 years. But Bob, Dave, Matt, who've been here roughly 15 years, are in their young 40s, and they have plenty of capacity to make new investments. Brian has been here over a decade and is in a similar age, and Sukin has been here almost a decade in his mid-30s. We've got highly engaged general partnership that we've built up over many years who have capacity to make new deals and sit on portfolio companies. At this point, I'd love to jump to page 12 to talk about how we source new investments, how we find new investments. So since the beginning of JMI, we've had a very proactive outlook on how to source new investments. That means the 20 investment professionals who work with the general partners spend a vast majority of their time talking to companies in the marketplace driven by themes. So David touched on some of the markets that we cover. But if you think about the B2B landscape, we will invest in almost any market of the B2B software market. We organize ourselves across those themes and those markets, and we spend a ton of time talking to companies, finding new investment, and making investment decisions. All we're trying to do is make 6 to 8 new investments a year, and in the last 12 months, we had meetings with over 500 companies. So we are in the market every day, building muscle, building conviction on which companies to invest in. If you turn to page 13, it gives you a quick look at our focus areas or our market map. We invest in both horizontal businesses that would focus on functional areas of a company. That may be talent, that may be IT, that could be sales, it could be marketing, or it could be security. We also invest in vertical markets, so higher education, finance, legal, and accounting, or insurance. We invest in companies that sell to state and local government and into healthcare. So it gives you a sense for we're in the market every day. We're organized against these market opportunities, these focus areas to go find the best companies we can to make these new investments. At this point, I think it makes sense to wrap up the presentation and open it up for questions. David, I can hand it back to you to ask for questions.
And I'll hand it right back to the Madam Chair.
Thank you, Mr. Aerosmith and David. We'll go now to questions from the committee. Do we have questions from council on the JMI Equity Fund 10 investment? Someone must have muted Member Eichenberg because usually we've got tons of questions for our investment. All right, with that we'll go. Do you have any questions, Mr. Treasurer?
No, Madam Chair, but thank you.
All right, with that we will go to a motion.
Madam Chair, based on the recommendation of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move the State Investment Council approve commitment of up to $50 million to JMI Equity Fund 10 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay, we've got a motion. Do we have a second?
I'll second.
All right, we've got a motion from Member Lavender and a second from Member Messina on the JMI Equity Fund 10 investment. And with that, I'll have Carrie call the roll on this vote.
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Peter Frank.
Yes.
Harold Lavender,
Yes.
Lee Rothman, Tim Jennings,
Yes.
Mike Messina,
Yes.
Nick Tejas,
Yes.
and Lee, let me go back to you. Are you?
And this is Lee. I pushed off instead of unhide. I'm for it.
Thank you. Madam Chair, again, a unanimous decision, 9-0.
Okay, very good. And thank the folks from Jmi for being with us today.
Thank you very much, Madam Chair. We're super excited to continue our relationship with the state. Thank you so much.
Thank you, Mr. Aerosmith. All right, we're going to move on now to our fourth voting item. It's a benchmarking review, and I'll turn it over to Vince.
Thanks, Madam Chair. Just 10 seconds worth of comment from me, and we'll go right to RVK. They did a lot of lifting on this report. We've been working on this probably for 6 months. These benchmarks are very important. It's an important part of your investment policy that you all oversee and monitor the office against. So we're very careful when we make recommendations here and try to do an extensive amount of work ahead of time. So Matthias Bauer at RBK's is going to brief this to you, and we had an extensive discussion at the investment committee meeting about benchmarks and this report. So hope you'll find this interesting and of value. So Matthias.
Vince, I'm going to start her off here. So, Madam Chair, Vince, we'll start on page 2 of the RBK document, which I believe is Diligent 264, and this is just the table of contents. So, I will start us off with an intro in a moment. We'll be covering the asset classes listed. Matthias will, and then he'll also cover total fund benchmarks and some recommendations. So, as Vince said, it's been a thorough process. With that, I'll take you to our page 4, your Diligent, page 266. And RVK and your staff believe it's important to periodically review benchmarks because of several factors, including the investable opportunity set evolves over time. A fund's return and risk objectives can change, and the type of diversification of the fund that the fund requires can change as well. And then certainly the market can present strategic opportunities from time to time. So we believe periodic reviews are very important. To say it again, this has been a very rigorous review involving your investment staff and RBK, and also with input from your specialty consultants. The goal of the review was to provide an understanding of past and current benchmark construction. We wanted to confirm that each benchmark provided an appropriate measure for success, and also to make sure that the benchmarks are flexible but representative of the current asset class structure, as well as its opportunity set. If approved, we recommend these benchmark changes become effective January 1st of 2021, so go back to the beginning of this year. The next page, page 5 of the RBK presentation is, we thought we'd share some Cfa guidance on benchmark, which is listed on this page. The guidance states a benchmark is appropriate if it reflects the Composites mandate, its objective, or its structure. And if the benchmark has many of the characteristics or properties, I should say, that are listed on this page. I said many, but certainly not all. For example, not all benchmarks that we use have a passive alternative. So under investable, not all of the benchmarks that are possible are investable. So again, many of the properties, but not all. Also want to mention on this page that it's important that the Cfa guidelines allow for multiple benchmarks. So we just wanted to point that out because that's going to be part of our recommendation as well.
And the routine, as I mentioned earlier, routine benchmark reviews are normal and they're appropriate. And in fact, they will be part of a couple asset class structure studies that are upcoming, and Matthias will mention that as well. Jumping to the next page, we thought before we jumped into the actual benchmark discussion and analysis that we did, we thought it would be helpful to review the types of benchmarks. And the first is the market indices, the most common. For example, today we reviewed your equity, U.S. equity composite benchmark, which is the Russell 3000. Your non-U.S., broad non-U.S. is benchmarked to the MSCI All Country World ex-U.S., and then we also roll that up into a global benchmark as well. Those are market indices. You can invest in those. Those are certainly the easiest to understand. Next are blended benchmarks, and the most common blended benchmark would be if you are in a balanced portfolio. Let's say you have a balanced mutual fund or just a balanced fund. A typical benchmark for those balanced funds is a 60% S&P, 40% Lehman Ag. That's considered a blended benchmark where you take two or more market indices and blend them. The third is our custom indices, and these are created to reflect a particular investment strategy. We use these for New Mexico for you on the strategies that are structured differently or are unique to New Mexico, and Matthias will go through those. And then we also have what is called a target return or absolute value benchmark, and this comes into play when there's no public market equivalent. So, for example, with private equity, as Matthias will review, it's often it's common to use a market index, a publicly traded market index, but add a premium, and that premium is added for illiquidity risk and the cost of investing in that asset class. So again, there is no public market equivalent when you use an absolute value benchmark. On the next page, another benchmark that's frequently used is peer groups. We talk about peer groups when we review your quarterly performance. These are commonly used. For example, you put in your policy or not in your policy that you expect a manager or a composite to perform in a certain quartile of the universe. There's drawbacks here. There's, for one, a peer group is typically not, you can't invest in it. There's survivorship bias. You can't link performance for longer periods, and they don't fill the criteria that we specify or was specified on an earlier page by the CFA. Because a peer group is typically a median return, you also can't, it's hard to look at statistics, risk statistics, for example, like standard deviation, because they're not meaningful because the median fund is different in each time period. So peer groups are nice information to have, but they're not the best benchmark. Certainly there are asset classes that you do use a peer universe because there's no investable index, and that would, the most common example of that would be for your real estate, you use the Odyssey index. Again, I want to point out that more than one benchmark is common and GIP compliant. A primary benchmark can be a market index, and then a secondary benchmark can be a peer group. So just a little background on top of indexes, and before turning it over to Matthias, on page 8 of the RBK, looking at the primary decision points when we're reviewing benchmarks. Does the benchmark remain appropriate for the asset class? That's the first question asked. If yes, we just reaffirm that benchmark. If we don't believe it is, then we go through some potential modifications. Do we adjust the sub-asset classes within the benchmark? Do we shift to a single benchmark, from a single benchmark to a multiple benchmark, or vice versa? And in this case, and what Matthias will review is it appropriate or is it best to use in certain asset classes a lagged benchmark approach, with which we have discussed and we'll discuss more today. With that, I'll turn it over to Matthias, who will kick it off with the easiest, which is core fixed income. Thank you, Madam Chair.
Thank you, Marcia. And Matthias, if you could direct us to page number when you start.
Absolutely, Madam Chair, and good morning, members of the council. Thank you for the time. This is T.H. Bauer. I'll be walking us through the various recommendations. We have them summarized at the end of the presentation to facilitate a consolidated vote, if that was the preference of the council, but we can also take them one at a time. I think the presentation is structured in a way to accommodate both, depending on your preferences. We will begin on page 9 of our presentation, 271 of diligence, which reflects the core fixed income asset class. And as we said, we're going to walk through the various asset classes and look at it on the total fund level as well, and hopefully from a sequencing perspective that will be useful. So for core fixed income, we'll start there. Public equities are relatively straightforward and benchmarked against broad and widely known public market benchmarks. So really not a lot of value in reviewing that. But we thought for core fixed income, we'd look at that in terms of structure. It is somewhat differentiated and wanted to re-underwrite that as a matter of good process. So beginning on page 9, you'll see the section for core fixed income starting, and on page 10 we actually have the core fixed income structure. I mentioned it's a more thoughtful structure perhaps than just investing directly in the broad market index, and that table at the top of page 10 or 272 outlines that current target structure. Now these are always somewhat subject to change depending on structural work that may occur or to reflect prevailing market conditions, but it's been the structure for some time, even though moderate changes can occur at times. And as you look at this, you'll notice we have this comparison as part of our capital market assumption process that we conduct on an annual basis as well, and we want to ensure that there's consistency throughout. One of the items that we always look at when we consider the core fixed income structure is how well it is represented by the main fixed income benchmark or the broad fixed income market as a whole, given the objectives, the exposures, and the characteristics. And even though the SIC has a somewhat differentiated approach to core fixed income, by the time you look at all these various aspects, you actually have a very similar look-through exposure and very similar performance in terms of this asset class relative to the broad benchmark. So at the bottom, you can see the historical performance in over 5, 7, and 10 years. In the long term, you'll see that the tracking is quite close, very similar performance and across exposures on a sector basis, as well as the overall characteristics of that asset class, all relatively consistent with some slight tweaks depending on expectations for the future. So all of that to say, we think that all of the modeling and all of the research that we've done, that the broad market benchmark, which is the aggregate index, remains appropriate for this particular asset class, and we're not recommending any changes to it. Happy to address questions as they come up or pause in between sections. Please feel free to speak up.
Sure. Yeah, let's see. Let's go to council and see if there's any questions on core fixed income. Okay, Matthias, why don't you keep us going?
Okay, great. We'll move on to the next section, page 11, or 273, diligence, which reflects your non-core fixed income portfolio. And one of the things I think I'll say as we move into the more non-traditional private market asset classes is that it's always a challenge to benchmark them for a number of reasons that we've discussed in many meetings leading up to today, as well as Marcia articulated in terms of sort of the unlisted nature of them and not being able to invest directly. So we have a number of challenges to overcome in this asset class and other private market asset classes. And for that reason, because there isn't a single best fit in terms of evaluating both short and long term, a lot of times what you'll find is that having a multi-benchmark approach to have a more bifurcated view or a time horizon can be quite helpful. And so we've looked at all of these asset classes which have a number of challenges extensively, weighed both the pros and cons of different approaches, and have some recommendations in terms of refinement to present to you today that we think will allow the council to have a more comprehensive view in terms of both the short and the long-term investment results of those asset classes. So I'll provide you with the recommendations at the beginning of each section, and then we'll discuss some of the underlying rationale there. And so again, on page 11, you can see those for non-core fixed income. The first is to adopt a multi-benchmark approach. So that's looking at both a long-term benchmark and a more short-term benchmark. The long-term representing more of a opportunity cost or return expectation. The short-term trying to get a better sense of what the alpha and relative performance is. The second item you see is really more administrative or operational nature, and that's replacing the HFRX with more widely known and widely available public index series counterparts for distressed and structured credit. And then the last item is the continuation of lags of the short-term benchmark, given some of the challenges in terms of data availability of the underlying investment, certainly on a short-term basis. We can move through the pages here, and on page 12, you'll see the non-core portfolio has a number of areas of exposure that primarily lean towards credit, although continues to be diversified. The target allocations are outlined for you in the table at the bottom of this page. And one of the unique distinctions for non-core fixed income, unlike core fixed income, you may recall some years ago when fixed income was split into core and non-core fixed income, given that they have very different purposes, is that for this, really, we're not just looking at capital preservation for non-core. Income, growth, and diversification all play a major role in this particular mandate. And as part of that, a number of the strategies tend to be less liquid, and for that reason, there should be a liquidity premium, at least over the long term. So additional return, additional compensation for having lower liquidity. And you'll recall, we've looked at this a number of different times. Liquidity is really not a problem for the SIC, and that's an exceptional tool to have, to be able to really look broadly across the capital markets to identify the best risk-adjusted return opportunities, and the non-core fixed income, certainly over the long term, represents a good area for that. But it can also complicate benchmarks. So we'll look at that, the current process, some of the challenges here. You can see those on page 13. The current construct is represented at the top, along with the benchmark. As I mentioned, one of the key recommendations for this asset class is the addition of a long-term benchmark that typically reflects in this space a reference benchmark. So here, a 3-month T-bill or what could be considered a risk-free plus a premium, in this case 4%, to really try and capture what the opportunity cost is of having lower levels of illiquidity. Now the 400 basis points, that's a long-term target across the full market cycle, and so rates are low right now, and you might say, well, 4% over T-bills are so low, that's not really a big hurdle. Well, the 4% is consistent, and obviously the T-bill moves up and down, and even though it's been quite low, we do expect that to go up at some point in the future. So we think the premium is a reasonable amount, and one that Axia, in terms of their views on how this portfolio is structured, is supported as well. And then the short-term benchmark, again, trying to get a better sense of what are the relative value drivers, is designed by having specific weightings in the portfolio relative to their benchmark. So consistent with what you're doing now, but some replacement in the underlying distressed and structured credit, changing HFRX benchmark to the ICE Bank of America Merrill Lynch counterparts that you see listed here. For what it's worth, historically, those have actually been a higher hurdle. So just in case you might wonder, well, is this going to, would this be an easier benchmark to beat? It hasn't been historically, so that's certainly not the motivation. It's just that the HFRX tends to be used for hedge funds. This portfolio has had hedge funds in the past, but continues to move away from that, and so it's really just a reflection of that. And one of the recommendations that Axia put forward was removing the 1-month lag, and we would certainly agree with that if we only had a single benchmark. But given that we have a short-term benchmark and a long-term benchmark, we think the 1-month lag actually can add a little bit of value and minimize some of the tracking error, at least on a short-term basis. So I think our recommendation is to maintain that, and we'll chat about that in just a second. I mentioned the data availability, and part of that just being the reporting basis of the actual investments and when valuations are available. You'll notice on page 14 or 276 of Diligent, we have the asset class reporting frequency and whether there is a mismatch. And you'll notice that for essentially all but the public market strategies, there is a lag in the reporting of the actual underlying investment, somewhere between 1 to 2 months. It's not consistent throughout, so since it's not 100% homogenous, it's sort of trying to find the best fit, and we certainly have done that. We've done quite a bit of analysis over the months in terms of what percentage of the portfolio is lagged and how can we optimize the timing mismatch, and our numbers and results. And you see some of that on page 15 or 277 of Diligent would indicate that the 1-month lag remains the most appropriate. So that is incorporated into our recommendation. And as you look at that at the top of page 15, green, the non-core fixed income composite relative to the pink, the very bottom line, which is the short-term 1-month lag benchmark that we're proposing. You can see that it's actually pretty close over the trailing 1, 3, 5, and 7-year time period. But again, not by any stretch of the imagination intended to be a lower hurdle. In a lot of cases, it's actually a higher hurdle, but we think it's a better fit given the underlying exposures. And so prudent changes. I'll pause there, see if there's any comments or questions before we move.
Thank you, Matthias. Any questions on the benchmarking recommendation for non-core fixed income? Questions from council? All right, if you'll move us on to private equity.
Thank you, Madam Chair. Page 17 or 279 of diligence, we'll move into private equity, and similar to non-core fixed income that we just reviewed, private equity tends to be relatively challenging to benchmark, particularly on a time-weighted basis. So all the reporting or the major reporting that you see from us is conducted on a time-weighted basis. A lot of the specialized reports that you see from Townsend and Mercer for the private asset classes tend to have a heavier emphasis on dollar weighted, and really the difference there is giving acknowledgement to the timing of cash flows being an important factor in the calculation, given that you commit capital and the general partner draws that capital down at their discretion. So another decision point that can be evaluated that way. And reconciling those two different methodologies can be somewhat problematic, although we try to do the very best we can. And every institutional investor has that particular challenge that pursues these assets, and most everyone does for all the reasons we've talked about extensively. So it's not unique to the SIC, but it is nevertheless one worth discussion. So in terms of the recommendation, you can see that here. The first is to just reaffirm the existing primary benchmark, which is the Cambridge, recognizing that there are some shortcomings. We'll touch on that in a little bit, although there's no clear better alternative. So we wanted to just confirm that was indeed the case. And the second is similar to non-core fixed income, adopting a multiple benchmark approach to just give you an even broader sense of how this asset class is doing. Mercer looks at that quite extensively in their performance review of this asset class, and we think it makes sense to incorporate here as well. And so this long-term benchmark, which would be the addition, is a public equity reference benchmark. So essentially say public equities plus some premium, and that premium is always intended to capture the opportunity cost of the illiquidity that should be compensated over a full market cycle. And of course, we've had a tremendous run in public equities over the past 10 years, and it's been very difficult for private equity to meaningfully add a premium over that, but that's not always the case. So we'll look at that as well. Moving on to page 18 of our presentation, just a little bit in terms of an overview for this asset class, and as the name implies, private equity tends to have investments in unlisted investment, and for that reason, there's no great investable index, of course, that can be used as a benchmark, but there are a number of different ways. You'll see them listed here on this page to benchmark this asset class. First, Marcia, when we talked about best practices and available options, and through some of these, is a peer group benchmark. Second is a reference plus a premium. That's one of the recommendations that we're proposing you adopt as well. And then the last one is on an internal rate of return or a private or public market equivalent, so on a dollar weighted basis as well. That's most meaningful, but again, it's difficult to reconcile in a time weighted report that is produced on an ongoing basis and that we provide to you. So recognizing that there are somewhat competing and I guess in some ways mutually exclusive priorities, a secondary benchmark can mitigate some of those concerns. So we'll talk about that in more detail. One of the challenges I would note is that we tend to have higher tracking error with the first two options because the differences relative to the exposures can be quite significant. Anytime you have a premium, so the plus 300 or plus 400 basis points over something, that is assumed month after month, quarter after quarter, year after year, even though it's an annual premium number, but some form of that, and it has no volatility. So that over the short term can create some meaningful differences and can skew your attributional results that we look at, trying to get a real good sense of what's driving the portfolio in terms of allocation, style tilts, or manager alpha. And so that can be a meaningful hurdle to overcome in this particular asset class. And what we've actually had some clients do is using the actual private equity experience just on the total fund level to mitigate that noise that exists between private equity implementation that may or may not be a very good match to whatever benchmark is available, and none of them tend to be that great over the short term for reasons that we'll discuss. On page 19, we wanted to provide you some context in terms of how do we come up with that secondary benchmark. You'll recall it's the MSCI ACWI. That is a global benchmark, so why global and why the 300 basis point premium. So these next two pages get into that detail. You'll see that at the top of page 19, we have the current geographic target allocation, at least for the national program, listed here. And you see it's not just a U.S.-based program. It is predominantly North America focused, but it also has exposure to Europe, Asia, and emerging markets. And so if you have something like the S&P 500 as your reference benchmark, you really wouldn't be capturing the full opportunity set. What we wanted to do down below in the middle part of that page is look at the index, the MSCI ACWI relative, the index's exposures relative to private equities exposures, and you can see that they're actually a pretty good fit. You also want to have a benchmark that's well known, so that when constituents and others look at this, it's clear that what the intent and purpose of the benchmark is. We don't want something that's obscure, that seems like it's too tailored. But from a regional or geographic perspective, we think that this is a reasonably good fit. You can see some historical performance down below to the degree that that's relevant, although somewhat looking in the rear view mirror. And then the next page, page 20, takes a look at the premium, what private equity historically has been able to deliver over the index or over the public market counterpart. And you can see that this is quite a bit of history here, 30 plus years thereabouts. The premium has been decreasing, but currently it's somewhere around 300 basis points. That is also roughly in line with what we're assuming for capital market assumptions. We talked about really there needing to do some reconciliation and having those numbers tie out, so that how we structure the asset allocation is also consistent with how it's evaluated. So the input and the output are measured on a similar basis. So again, historically, when you look at it on a rolling basis, these numbers are rolling. Premium has been higher, it's continued to come down, but we think that 300 basis points over the long term is a reasonable expectation given this information on the aggregate. Madam Chair, I'll pause again before we move into the next section.
Any questions on private equity? All right, Matthias, why don't you finish up with the next two asset classes and then any portfolio benchmarking remarks, and then we're gonna, I'll go to questions after that.
Okay, great. The next two, real estate and move return, we'll just cover very briefly because they're more informational. As the cover page says, there is an upcoming structure study that Paul and his team will be working on along with the specialty consultants. But we wanted you to have this information in terms of how it's constructed and foreshadow that there may very well be changes to reflect whatever refinements may be proposed coming out of that structural work. And so likely we'll see a more nuanced approach to real estate benchmarking. Right now, it's just the Odyssey, which is sort of the very broadest benchmark for core properties. But as that portfolio continues to diversify into value add and opportunistic exposures, a more nuanced approach to benchmarking there would make a good deal of sense. So we'll come back to you on that at a later time, and then we'll return similar across the benchmarking there currently reflects I would say a very high level approach to the types of objectives that asset class has, but the implementation actually looks very different. One of the distinctions that we make during the annual capital market assumption setting process, and also may expect some changes in terms of target structures coming out of that structural work over the next maybe 6 months or so. So with that, we didn't want to put the cart before the horse and recommend any changes, but just foreshadow that those will likely come down the line. The one big change you will see is similar to some of the other asset classes, both a short-term and a long-term benchmark, with that long-term benchmark being inflation being measured as CPI. Again, real return by and large is based in inflation, and wanting to have a hedge against that, but with some premium again to compensate for your liquidity. So having a long and a short-term benchmark is likely a future recommendation that you'll have us present at a later date. So I'll pause there before we move into the total fund benchmarks and wrap up as quickly as we can.
Questions from council? All right.
Okay, thank you, Madam Chair. That covers all of the asset classes, and now on page 294 or 32 of our presentation, we'll move into the implications of the total fund benchmark. So we've looked at all of the various asset classes, but right now we need to roll it up to the total fund level, land grant, severance tax, but then also all of the other permanent funds and the new funds that have been added over recent years. We're only going to cover land grant and severance just out of time and process reasons, but of course, any change that is being recommended and approved for land grant and severance, we would apply that to the other permanent funds where it's applicable. So I just wanted to foreshadow that. The first change is on page 33. You'll recall that over the years, we've made some significant changes to the strategic asset allocation and the policy targets of the portfolios. And for that reason, because the differences in terms of what the final target is and where we were at was so wide that benchmarking one versus the other didn't make a lot of sense. So there was an interim target that was adjusted as we converged with the long-term target, and then a long-term target, but really the interim target is the one that we looked at most frequently. Now that a lot of progress has been made in terms of moving the interim target towards the long-term target, we think we're close enough to drop the interim and just focus on the long-term target. So that's a big achievement in terms of getting there. Some minor differences remain, but really, I think we're close enough there. So that's the first recommendation on the total fund basis. The second is on page 34 and 35 as it relates to the private equity benchmarking and on the total fund level. Now, this is different than the asset class itself, which is on the total fund level. We discussed some of the challenges of benchmarking private equity. At the total fund level, though, it creates some additional complexities and problems, and we wanted to discuss those. As I said, Cambridge is fine, particularly for the asset class. I think we're going to get, even though the construct of that index tends to include endowments and foundations, investors and LPs that tend to lean more towards venture and smaller funds just based on how that index is constructed in the origins of the index. And that's not a great fit for a large-scale investor like the SIC. So there can be a little bit of a underlying exposure mismatch, but recognizing those differences, we think it's as good as we're going to do there. But that difference can introduce, particularly over the short term, some pretty significant mismatches, and sometimes we see that in the attribution coming through. So one of the items that we wanted to present you with is the various approaches that are being used for private equity benchmarking at the total fund level. You see that on page 35. I'll just say right up front that there is no perfect approach. They all have advantages and disadvantages. The first being lag public market index plus a premium. So one of the recommendations that we're making on the asset class level, but wouldn't make that recommendation on the total fund level. Number one, it doesn't have any volatility in the premium, as I already mentioned. It doesn't represent the private equity market either, and so we don't think that that's a terribly insightful way to do that. The second is the current approach with a private equity peer group benchmark like Cambridge, and again, that you can have some sizable differences in terms of exposure. Data availability and in terms of how it's updated can be challenging, and all of that results into skewing attribution and really having the selection impact sometimes is just as significant as the allocation impact. And then the final way of doing it that we've had some clients move towards is actually just using the private equity portfolio experience as part of the policy index to still have the allocation impact. So you're still getting this private equity add value or detract value in terms of absolute or absolute measures, but minimizing or neutralizing the selection impact or the mismatch impact, which we think probably is a reasonable trade-off to make. Again, the asset class itself, we're evaluating most effectively through the Mercer report or on a PNE and IRR basis. And when we think about it on a total fund level, what do we care about? It's capturing the actual allocation impact, but probably not having that be dominated by the selection impact. So that would be the recommendation there. We can see these changes shown on page 36 and 37, the land grant and severance tax. At the bottom, how the asset classes are consolidated and some of the changes reflected in blue and crossed out text. Additional changes forthcoming for real estate and yield return, but just so you can have a visual in terms of what it looks like now and what it might move towards if you were to make those or adopt those recommendations. Page 38. But it's helpful to include, as I already mentioned, this is land grant and severance, that you have other funds that also have exposures to some of these various asset classes, and I just wanted to present that to you in terms of what might be impacted, any changes that are approved, you can apply across the board, as shown in this table on 38. And then I'll just close on page 39. That is the summary of recommendations. You can take them individually or in aggregate. Yeah, thanks for the time and happy to take any questions about.
Thank you, Matthias, for that very thorough report. And that page 39 is a good summary for members to take a look at what all of the recommendations for benchmarking are. So the way that we have the motion written is that we are going to break out non-core, private equity, and total fund, but can we do that all in one motion?
Madam Chair, that was the recommendation of the investment committee that we do that in one because of the nature of this particular approval. Obviously, if the council were to want it broken up, we can certainly do that. But the recommendation is based on this coverage by Matthias today that we do it in one motion.
Does that work for council members? The way the motion is written at the bottom of our agenda?
Yes.
Is that Peter?
Yes, that was me, yes.
Okay. So, are there any further questions on this recommendation? All right, so with that, we will take this all as one motion, and Member Lavender, are you ready to make that motion?
Yes, ma'am. I'll try not to be too tongue-tied on this one. Based on the recommendation of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve the following recommendations to the SIC's asset class benchmarks as memorialized and discussed by the Council at today's meeting. 1, non-core fixed income. Adopt a multiple benchmark approach by adding ICE BOF AML-3-month T-bill index plus 4%. As a secondary long-term benchmark, replace HFRX with ICE BOF AML for distressed and structured credit and continue lagging short-term benchmark. Number 2, private equity. Reaffirm existing primary benchmark, Cambridge, and adopt a multiple benchmark approach by adding global public equity reference benchmark MSCI ACWI with a 300 BPS premium as a secondary long-term benchmark. Number 3, total fund. Consolidate interim benchmarks into the SIC's long-term policy benchmark. Replace the core fixed income custom index with the Bloomberg U.S. aggregate index, and use private equity composite performance in the policy index for time-weighted return, TWR purposes.
Wow, that was wonderful. Member Lavender, thank you for a second.
Okay.
We have a second. Okay, we have a proper motion by Member Lavender, a second by Member Messina. Do we have any discussion on that motion before we go to a vote?
Somebody else wrote the motion for it.
I have a
question. I think he came up with all of those acronyms off the top of his head right now on the spot. So I give him full kudos for that.
I have a question, if it's okay. At this point, I'm sorry I should have asked it earlier.
Member Frank.
Matthias, could you just tell me what ICE stands for? Am I off mute? You are now?
Yep.
Okay, great. Yeah, that's Intercontinental Exchange, I believe. Okay, thank you.
All right, are we ready for a vote on this motion to accept the benchmarking recommendations as memorialized by Member Lavender? Carrie?
Commissioner Garcia Richard.
Yes.
Secretary Romero.
Yes.
Treasurer Eichenberg.
No.
Peter Frank.
Yes.
Harold Lavender.
Yes.
Lee Rothman.
Yes.
Tim Jennings.
Yes.
Mike Messina.
Yes.
Nick Tayet.
Yes.
Madam Chair, that's an 8-1 vote.
Okay, thank you very much, Carrie. And with that, we're going to move on our agenda. Our last voting item on the agenda is 3F, the Fixed Income Manager Contract Extension, and I will call on Vince.
Well, thanks, Madam Chair. Just very quickly for me, this is a recommendation, or we're seeking the council approval on recommendation to extend BlackRock's contract in the core fixed income portfolio. This is a manager well known to you. We've got several strategies throughout the portfolio with BlackRock. Over the life of their existing contract, they've performed very well for us and have charged us very competitive fees. All that information you can see in the memo in your book. So we're recommending that we extend with them the same strategy for 4 years for a contract to expire in 2025.
All right, is there any discussion or questions on that recommendation?
Madam Chair, this is Member Romero.
Yes, Member Romero.
Staff, thank you. Can staff explain a little bit about how we procure services and also how we can extend contracts? Is there a competitive bid process? I mean, how is it handled internally?
So, Madam Chair and Secretary, the investment management services that we have are exempt from the procurement code. So our process really is embedded in our investment policy. Typically, when we're hiring a new manager, we'll do a full RFP that you'd recognize, for any sort of service procurement. Do extensive work that way. Once we have managers on board, that have ongoing strategies such as this one, we typically do a contract renewal. You'll typically see a 4-year renewal. If we get extended, so if this contract was, you were to approve this and this contract ran the 4 years, it's likely we do a fuller review, maybe even at minimum a market survey and maybe even a full RFP. Just when it's gone that long, 8 years, we probably would look a little deeper into the market. But to get to this point here, really, we just reviewed fees from other managers that do this sort of thing, make sure our fees are still in line, and then review performance for you, to make sure we're getting out, from the manager what we've contracted for. So this is pretty typical after for a renewal. Again, probably 4 years from now, we'll do a little deeper dive into what's in the market.
Okay, thank you. Just being new to the committee, I'm just trying to understand all the processes that are in place. So I appreciate the explanation. Thank you.
Madam Vice Chair, if I could just add.
Member Romero. Yes, Member Lavender?
I'm sorry, I just wanted to add, one of the keys to these kinds of contracts is if you look under the recommendation on the page, the contract can be exited upon 30 days notice. And so many of our contracts are like that. And that always gives me a significant amount of comfort that if it turned out that this weren't working the way it was supposed to, or if the staff were unhappy with it, that we could exit it very quickly.
Thank you for that addition, Member Lavender. Any further questions on this recommendation? And Vince, when you say that probably in 2025 we'll take a broader look at this, how is that 8-year sort of magic number determined? Is that written in our investment policy anywhere, or is it just kind of a rule of thumb?
We've just been using that as a sort of a rule of thumb. We don't necessarily, go through a whole new RFP at that time frame. We may do a request for information. In a strategy like this, that's pretty commonplace. I mean, this is a very commonplace strategy. It's a treasury only portfolio. We'll make sure our fees are in line and then the performance is in line. But because it's so common out there, switching managers costs us a good bit to switch assets from one manager to another and have them sort of reform the portfolio. It's usually not, as long as our fees are in line and our manager's doing a good job, it's usually not, something that we switch.
Any further questions before we take a vote? All right, so the recommendation from staff is to extend the contract with BlackRock for the fixed income portfolio for another 4 years.
And do I have a motion?
Yes, ma'am. This one's a lot easier. Based on the recommendation of the Council Investment Committee, SIC staff in general, producing our oversight of RBK, I move that the State Investment Council approve the renewal of a contract for fixed income manager BlackRock Institutional Trust Company as memorialized and discussed by the Council at today's meeting.
Is there a second?
Second.
I'll second.
Okay, I think I heard a second from Jennings and then also from Messina. So we have a proper motion. We have a motion and a second. If I could have Carrie call the roll, please.
Commissioner Garcia Richard,
Yes.
Secretary Romero,
Yes.
Treasurer Eichenberg,
Yes.
Peter Frank,
Yes.
Harold Lavender,
Yes.
Lee Rossman,
Yes.
Tim Jennings,
Yes.
Mike Messina,
Yes.
and Nick Taya.
Yes.
Unanimous decision 9-0, Chair.
Thank you. Okay, we will go on now to agenda item 4, finance matters, and we're going to hear from our Chief Financial Officer, Brent Shipp, on the CFO report.
Thank you, Madam Chair and council members. I'm on page 314 of the diligent material. Just a couple of things to point out, if I may. As I've done in prior months, item number 1, I have attached the budget to actual comparison for the 6 months. I don't have to go in a lot of detail. I think we're operating fully within the budget guidelines. I don't see any problems getting us through the end of the fiscal year. The investment holdings report that is attached, I think it's starting at page 321. You'll note, because it's a quarter end, it's a little thicker than it normally is. You see a roll forward in the funds and by clients, not only on a monthly basis, but a quarterly basis as well, since we're at a quarter end. And then item number 3, the agreed upon procedures. The auditors have begun work on that. In fact, I think yesterday I sent out all the confirmation requests to managers. They are currently working on the agreed upon procedures for the first 2 quarters because of the timing of the completion of the external audit. That first quarter is typically started a little bit later than normal to allow for the audit completion. And then they have a March 31st deadline to get the first 2 quarters done, and I wouldn't anticipate any problems with that. And then if you can turn over to page 384, this is the last page of the investment holdings report. I usually like to point out a couple of things on that. As you can see on the first bullet, the monthly contribution from the state land office for the month was $80.7 million, which is a decline of about $7.9 million from November. For year-to-date comparison purposes, the prior December, which was December of 2019, was $95.2 million. Also, on the third bullet, I did want to point out, I think this has been mentioned in the past, but I did want to point out that the Severance Tax Permanent Fund received a transfer of $29.2 million in the month of December. And then right below that, we were expecting a large transfer to come in from the Tax Stabilization Reserve Fund. It did come in $439.8 million. And then the
because I have promised it in the past. If you turn over to page 388, I did include the audit report, which was just recently released, and there's typically a waiting period on actual release to the public for 5 days unless you seek out a waiver, which we typically don't do because we're not under that type of time pressure. But on page 388, I did want to point out just, especially for our newest members, just the particular sections that they might want to refer to if they want to spend time on this. 388 to pages 390 is the actual opinion of the auditors. This is the main thing that they do. They take it pretty seriously. It is a clean opinion. It's been that way for as long as I can remember. And then if you turn over to page 402, I did, because there are oftentimes some discussion and questions regarding where the actual funds show up. And we actually have two different sections of the audit report. The government funds, this is basically on 402, a balance sheet for the governmental funds. You have the admin fund, which is where the budget is actually kept and those monies are distributed. You'll see the land grant permanent fund, the severance tax permanent fund, the tobacco settlement permanent fund, and then the tax stabilization reserve fund all are within this balance sheet. If you turn over one page to page 403, actually 404, it's basically the income statement. It's titled a little different. It's called the Statement of Revenues and Expenditures, but it's basically an income statement for the governmental funds. And then if you go over to page 407, this is where the remaining funds are, the Water Trust Fund, the Endowment Trust Fund, and the External Investment Trust Funds, which are clients. These are considered fiduciary funds. A little bit different, but they're still showing up just in a different section of the report. If you turn over one page to page 408, there's the actual income statement or statement of changes in net position for the fiduciary funds. On page 460, this is one section I tend to try to focus on. It's the report on internal controls, 460 and 461. Typically, we have not had any problems here, continue to not have any problems, and hopefully going forward, we'll continue to have a clean report on both the audit and the internal controls. And then if you turn over to page 463, I think I've mentioned this before, but we're very proud that we don't have any findings during this audit period, nor in the prior audit period. So that's really all I had, Madam Chair, and I'll open it up for questions if there's any questions on any of the material that I provided.
Thank you, Brent, as always, for the keeping of our financial health in good order. And good luck on your budget hearing. Mine was yesterday.
I'm glad you brought that up. We do have a budget hearing. We do have a budget hearing tomorrow. We've gotten some preliminary indications from LFC. We're going to be fine. They typically, because it's been kind of hard to hire people, they typically have cut the personnel sections of the budget request a little bit. I would expect that to be the same way this year. But as far as contractual services, they typically allowed us some flexibility as far as what we need there as far as the budget is concerned. One of the more important things to remember and always emphasize this in all of our hearings is any unused monies that come in through the budget at the end of the fiscal year after the audit is completed is reverted back. But that's all I had. Now, I also did want to say relative to Vince's response and Secretary Ramiro's question about, going out to bid. We do have a procurement exemption on the investment side, and if she wants to see that statutory exemption, I'm happy to provide that as well. So that's all I have.
Thank you for that, sir. Any questions for Brent?
Madam Chair, this is Harold. I just want to make sure that we recognize what I consider to be pretty incredible work by Brent and his staff. Peter is in a much better position to talk about this than I, or comment on it, but I'm just amazed at the magnitude of what we're doing at the SIC, and we just continue to get no findings and consistent reports like this. So tip of the hat to Brent and his staff.
Thank you, Member Lavender. Anything
Thanks, Peter Frank, and I certainly second that. I've enjoyed very much working with Brent over the years, and he's done an outstanding job, and I think we're taking a lot of comfort in having him in that position.
I think it can't be overstated, just the amount of transactions, assets, everything that flows through this organization, and to continue to be evaluated by a third party year after year, and come out with a clean audit, I think it speaks volumes, Mr. Schiff, for you and your staff, so thank you.
Thank you.
Madam Chair, this is Tim, and I would just echo those comments that all of you members have made. Brent has just done amazing work for the state of New Mexico, so thank you.
All right. So with that, we're going to move to agenda item 5, closing matters, old and new business. I know that I have a member from the Stakeholder Equity Project on the line that I would like to hear from, but there is also this A1 Audit Committee Advisory Member agenda item. So let's begin with that.
All right, it's Peter Frank. I chair the Audit Committee. Over the last 7 or 8 years, we've been fortunate to have an advisory member named Jim Goodwin, who brought unique expertise and competence to the committee. Jim, of course, reached the point where he wanted to retire, and he did recently, leaving us with an opening. We have located Mike Everett, who's equally competent and has an incredible resume, and has agreed, if appointed and approved by the council, to serve in an advisory capacity as well. Michael has been a CFO at a number of companies as well as CEO, and he serves on a number of audit committees as chair, brings unique experience, and I think we are very fortunate to have him agree to join the committee, and I'd like a concurrence from the rest of the council that we extend the invitation.
Thank you for that recommendation, Member Frank, and I'm wondering, would you take any kind of questions and comments from the council at this time?
Yes, of course.
So just for members' edification, Mr. Everett's resume can be found on page 468 of our material.
This is Lee. If you needed a motion, I got a second.
I'm not sure we need a motion. I didn't see it on the agenda for voting items. But
Madam Chair, this is Steve. We do need a motion. We would appreciate a vote on this topic, please.
I think that's best. I'll second Peter's motion.
All right, thank you very much.
Okay, so we've got a proper motion and a second to approve Michael Everett as an Audit Committee Advisory Member. And like I said, we've got Mr. Everett's resume here. Do we have any discussion, questions on that motion? Discussion on that motion?
Madam Chair, this is Tim, and I'm trying to review whether or not if we noticed it correctly, so that we can have a vote and make this guy a member of that commission. So I would ask you, Madam Chair, for
or we could hear from Evan or Bruce, whether or not we can do a voting item having not had it.
This is Evan. Well, I don't think a vote is necessary. I think a concurrence would get him on because there is no noticed action on our agenda. I don't think you should vote a motion through pursuant to our transparency requirements.
Thank you for that advisement, Evan. And so with that, Member Frank, if we could just have concurrence from the
Yeah, I think that would be adequate if everyone concurs, or if there are no objections, we would extend the invitation and ask Mike to participate.
Is there any objection? Okay, so we have concurrence from the council to invite Mr. Everett to be an advisory member of the audit committee. Thank you, Member Frank. Okay, I believe we have Lisa Giacono on the line. Charlie, is she here with us? Okay, I believe we have. Hello.
Madam Chair. Yeah, this is Charlie. I'm getting an email from one of the participants, although I thought I heard Alyssa there. Alyssa, are you on the line?
Yes, I am.
Why don't you go ahead and start? You can connect with Eileen O'Grady.
Yeah, I've invited Alyssa to give us a summary of a letter that the Stakeholder Equity Project sent to council members regarding our Leonard Green investment. So, Alyssa. Thank you, Madam Chair. We really appreciate the opportunity to address the council. We are honored to be here. My name is Alyssa Giacchino. I'm a director with the nonprofit Private Equity Stakeholder Project, and hopefully in a moment we'll connect with my colleague Eileen. We work with stakeholder groups to understand the impact of private equity investment in a number of industries, including healthcare, housing, labor, civil rights, and the environment. We've prepared comments that will last approximately 10 minutes, and we will be happy to take questions. And so we are here to present on Leonard Green and Partners, which the SIC has a significant partnership with. Leonard Green owns Prospect Medical Holdings. Prospect is a safety net hospital chain that operates 17 hospitals in 5 states. A safety net hospital is obligated to treat patients regardless of their insurance status. So these are hospitals that exist to serve some of the country's most vulnerable populations. I want to address issues with this hospital chain now, given the urgency of protecting safety net hospitals during the COVID-19 pandemic and the SIC's exposure to this investment. Since Leonard Green acquired Prospect in 2010, it has used the hospital chain as a platform to raise debt so it could siphon off hundreds of millions of dollars in dividends and fees. According to Prospect's own financial statements, the owners have collected at least $658 million from the hospitals, despite dramatic operating challenges, substantially underfunded pensions, and increasing regulatory scrutiny. Leonard Green is now trying to walk away from Prospect. It is selling its majority stake in the hospital company for just $10 million, a nominal sum. It is concerning that Leonard Green would value a majority stake in a 17-hospital health system at such a low price, given the hundreds of millions of dollars that owners have extracted from it in recent years. Leonard Green's aggressive gutting of Prospect and its hospitals has garnered substantial concerns from workers, lawmakers, regulators, and investors across the country. Eileen, are you with us?
I am. Can you hear me?
Yes.
Hello?
Go ahead.
You can hear me? Okay, great. We can hear you, Eileen. Thanks so much for having us. All right, sorry about the connection issue. So, yeah, I guess I wanted to highlight why this is relevant to the SIC. So the SIC is a significant investor for Leonard Green. You're invested in the fund that owns Prospect, which is called Green Equity Investors 5. You've invested in several other subsequent private equity funds that Leonard Green raised, and each of those funds has made other healthcare investments. Leonard Green, in general, touts healthcare as one of its core areas of investment. And so there's substantial regulatory and headline risk here posed by Leonard Green's looting of Prospect. There's an in-depth investigation of Prospect by ProPublica late last year that found a disturbing pattern of safety and quality issues at Prospect hospitals, in every state they operate, from California to Pennsylvania. In addition to ProPublica, multiple other outlets have written about Prospect and Leonard Green, including the Wall Street Journal, Bloomberg, Modern Healthcare, Pensions and Investments, several regional newspapers, and just last month, the Wall Street Journal wrote that the dividends that Leonard Green took from Prospect were, quote, some of the most controversial debt-financed dividend payouts in recent years. Last summer, a group of Congress members with Prospect hospitals in their districts wrote letters to Leonard Green voicing concern about Prospect. The Rhode Island Attorney General and Department of Health, which are now reviewing Leonard Green's application to sell its stake in Prospect, have extended the review process 3 separate times. They previously cited unanswered questions about the dividends and the troublingly low purchase price as reasons to delay their process. The Rhode Island Treasurer, Seth Magaziner, who oversees the Rhode Island State Investment Council, which is also invested in Leonard Green, wrote a letter to Leonard Green saying that due to its harmful management of Prospect, the State Investment Commission wouldn't consider any future investments with Leonard Green. Some of Leonard Green's other limited partners have demonstrated dissatisfaction with the asset manager. A number of their biggest repeat investors declined to re-up with Leonard Green's latest fund, including the Oregon Investment Council, the Wisconsin State Investment Board, New York City funds, and others, and the Florida State Board of Administration and the Illinois Teachers Retirement System have sold all of their holdings of Leonard Green on the secondary market. But I want to talk more specifically about the impact of Leonard Green's ownership of Prospect and the money it and the minority owners have taken out of it. The largest dividends that Prospect owners collected in 2018 directly contradicted a commitment Prospect made to state regulators when it bought several hospitals in Rhode Island in 2016 and told those regulators that it wouldn't pay out any more dividends. Just a few years later, it paid the ownership group an almost $460 million dividend. And that same year, Prospect generated a $244 million net loss. As a result of that dividend, Prospect ran out of cash by early 2019, forcing the owners to provide an emergency cash infusion. Prospect was eventually able to pay off the existing over $1 billion in debt that it had accrued in part to fund those dividends, but only by selling off the bulk of Prospect's real estate to a REIT. The transaction replaced debt with lease liabilities and left Prospect with fewer assets. I want to take a moment to address something that Leonard Green may have shared with members of the council. A report by an independent firm hired by the Rhode Island Attorney General's office that was meant to review questions about Prospect hospitals in Rhode Island. So this report was made public earlier this morning. So I haven't had a chance to read the whole thing thoroughly, but I can say that the report was focused on answering a very narrow set of questions specific to Prospect hospitals in Rhode Island. These were largely questions about whether Prospect fulfilled capital commitments as a condition of acquiring and converting the hospitals in Rhode Island. The report concludes that Prospect fulfilled those baseline requirements. This does not refute the fact that Prospect paid those massive dividends. It doesn't refute the quality concerns across the company in multiple states. It merely states that Prospect fulfilled the bare minimum requirements it was legally bound to per the original asset purchase agreement. This doesn't mean that the state Attorney General's office in Rhode Island and the Department of Health are done reviewing Leonard Green and Prospect. And I also want to reiterate that much of what we know about Prospect's financials, including the dividends and the fees, is disclosed in the company's own financial statements and disclosures made to the state agencies. So I just want to be clear, this report in no way absolves Leonard Green's actions with Prospect. I just want to briefly also talk about what was happening on the ground at the hospitals while Leonard Green was siphoning money from the company. Those hospitals have some of the lowest quality ratings from the Centers for Medicare and Medicaid Services. Prospect completely shut down all of its facilities in Texas at around this time last year, laying off nearly 1,000 workers, and sold its downtown San Antonio hospital building to a hotel developer. Multiple lawsuits have charged Prospect's Culver City Hospital with different allegations of billing fraud, including one lawsuit that claims that the hospital needlessly admitted homeless patients to inflate Medicaid revenues at its detox centers. Last year, the California Attorney General formally charged Prospect executives with gross negligence related to persistent mold contamination at a hospital pharmacy, including in equipment used to mix patient medications. And those pending attorney general proceedings could revoke or suspend the hospital's pharmacy permit. So these kinds of problems are magnified in the COVID-19 era. I just want to share one example. In Rhode Island, poor infection control allegedly led to COVID-19 infection of 19 of the 21 geriatric psych ward patients at a hospital, and I think staff also got COVID, and the head of that department died. So we also have a comment we'd like to share from Ed Gadomski, who is a former IT worker at Prospect Waterbury Hospital in Connecticut. He was unfortunately unable to join the meeting today, but asked us to share this comment on his behalf. And I'm going to ask Alyssa to read that.
Yes, so speaking for Ed, quote, "My name is Ed Gadomski. I have been a 32-year employee of Waterbury Hospital working as desktop support specialist for the IT department. On July 17th, 2020, Waterbury Hospital received a $17 million property tax break from the city of Waterbury. Before approval, hospital management explicitly stated there would be no elimination of jobs. In fact, the hospital was looking to create and add more positions so long as the city approved the tax break. That was not the case. On August 3rd, just 2 weeks after Prospect got the tax break, my entire department was told we would be laid off effective September 1st. Our positions were being outsourced to India. We were told we could reapply for our positions and would be offered wages and benefits comparable to the current status. However, that was not the case. I was a 30-year employee of the hospital, and I was offered $13.46 per hour. That's about 1/3 of my salary. I had no choice but to collect unemployment benefits during a national pandemic because of the large decrease in pay. On top of that, workers were told they must find their own insurance, as the new outsourcing company would only pay a fraction of what is necessary for a family insurance plan in Connecticut. The company also wanted the employees to be on call during unscheduled hours for free, and stated that they would no longer contribute to any retirement plan. On top of receiving millions of dollars from the CARES Act from the federal government, Prospect Medical Holdings, which owns Waterbury Hospital, paid out dividends of $658 million between 2016 and 2019. Why is that money going to line the pockets of wealthy investors instead of being put into our hospitals? As some of the biggest investors in the Wall Street firm that owns Prospect Medical, which is running my hometown hospital into the ground, I ask you to please don't stand by and watch this happen. Please tell Leonard Green that you are not okay with your money being used to justify taking hundreds of millions of dollars out of Safety Net Hospital, hurting my job, my former coworkers, and the community our hospital serves." Unquote. So I would just like to conclude that we're concerned that Leonard Green's management of Prospect may in fact be part of a larger pattern. As Eileen mentioned, Leonard Green is a perennial healthcare investor, and we've seen similarly aggressive financial policies at other Leonard Green-owned healthcare companies. The more we learn about Leonard Green's ownership of Prospect, the more disturbing the story becomes, and these problems are not going to go away, especially if Leonard Green continues to evade responsibility for the grave safety and quality concerns at Prospect under Leonard Green's ownership. Moreover, Leonard Green continues to justify its gutting of Prospect by touting its returns for investors like the SIC. You should not feel comfortable being used as a shield for looting Safety Net hospitals. We believe that Leonard Green should give back the dividends it has taken out of Prospect so that the hospitals have adequate resources to respond to the pandemic. As one of Leonard Green's biggest investors, we're asking you to stand up to Leonard Green and let it know that you will not tolerate the SIC's capital being used to undermine critical healthcare services. We're happy to provide a sample letter that you could consider sending to Leonard Green that outlines some of the fiduciary concerns of this investment, and we're available for any questions. Thank you so much for your time.
Thank you, Alyssa and Eileen, for being here to present. Do we have any questions from council members for these ladies? All right, well, I am the one that invited these folks here, and I, for one, since I'm responsible for the inflows that
this council invests from our state land. I would like us to have a critical eye on the investments we make. So I will be following up on this particular item.
Thank you, Madam Chair. This is Tim. And I just want to say that I've known Seth Magaziner as a treasurer from the East Coast for 6 years. And he's just a top-notch, smart individual that does the right thing. So I'm going to take a little bit closer look at this as well. Thank you, Madam Chair.
Madam Chair, this is Nick Chayes here.
Number 2.
Yes, thank you for coming forward. Madam Chair, thanks for bringing this issue to the forefront. The information provided by the public comments are for me just very concerning, deeply unsettling, and I think that the council needs to take the words that have been provided by this group of individuals seriously, and I think that we need to take a look at the concerns raised, especially, as we invest state public tax dollars. We need to, I think, have as much as our fiduciary responsibility is to generate earnings, I think it's also very important that there's consideration for proper management of these funds and the investments that we approve. We need to make sure that we are safeguarding the resources of the state, but also making sure that there's some ethical principles that are utilized in terms of how we manage these funds. So I would support you, Madam Chair, in continuing to look at this issue, and I do encourage our staff to take a look at it and bring back to the council some recommendations and some information that we can be able to utilize to just further examine this issue. It seems like a serious nature, so just want to urge us all to take these comments very seriously. Thank you.
Madam Chair, this is Jenny.
Member Jenny.
And I served with Tim for the other Tim, Senator Treasurer Eichenberg, for a long time, and if he tells you guys jam up, he's jam up. But, in all fairness, if we're going to do anything on this, we probably certainly ought to have a hearing on the other side and hear the other. If there is another side, we should hear it, and then we should make an appropriate decision. And you just got to be fair in what we do and listen to both sides. And I would encourage us to do that. And with that, I'm going to have to sign off. I have a doctor's appointment I have to go to. So thank you all very much.
Thank you. Madam Chair, anyone? Yes, Member Rivera. So I think I want to echo Member Tejas' comments and concerns. I think any time that information like this is presented to a committee, a council, whatever, we've got to listen and we've got to, yes, there probably are two sides to every story, but I think for us to do nothing is to accept potentially bad behavior, and I don't think we want to be seen as doing that. And so I would strongly recommend that we look into this further, and that if necessary, that as Member Jennings mentioned, that we get both sides of the story before we make any kind of decision. This also makes me, and the other question that I have, I think that the swing in the back of my mind is, so when these proposals are brought to the Investment Council, we basically listen to their presentations, but is there any other kind of research that's done at the staff level to make sure that whoever we're investing with
doesn't have these type of problems, that there aren't these kinds of concerns going on. And if not, maybe it's something that we need to consider moving forward.
Thank you, Member Romero. And I don't know if Steve, if you or anyone on the staff wants to take that.
Commissioner, yeah, I will ask Vince if he will to comment on that, but we do go through in-depth due diligence work on every investment we bring to you. We do it at a staff level. We ask our consultants to do that. And Vince, if you would, add whatever you wish.
I just echo Steve's comments. We go through an extensive diligence process. Part of that's reviewing ESG policies and things that our managers propose to us. That they've got incorporated in their investment processes.
Hi, this is David Lee, Private Equity Director. If it pleases the council, Richard Pugmire is on the line from Mercer. He can maybe quickly go through some of the things that they do to review ESG for every investment.
Could you just clarify for everyone listening what ESG is, Richard?
Yeah, ESG stands for Environment, Social, and Governance, and it reviews and it refers to kind of the other part of investment that's important. It's not just about return; it's about being good to the environment, being good socially, and having good governance practices. And so, in the due diligence process, that's really how we evaluate these types of risks and talking to the manager about their strategy, how they create value. We don't want managers that are just going to lever up the company, and we want managers that are going to create value by building better companies. And we talk to portfolio companies, both current and past, to understand how they've worked with the fund management teams. And then on the ESG side, we talk specifically about their ESG policy and how things are actually implemented within the firm. And you saw this in the JMI report and other funds that we brought. We actually have a strong focus on the ESG process. We have a separate page to call it out. And the thing that we're really looking for there is we don't want just an ESG policy, because that's something we've seen in the past where a manager will put together an ESG policy and then they'll just kind of file it away until they raise the next one. We really want to see implementation of the ESG policy. We want to see it in their due diligence process, and then we want to see it post-investment. When they're serving on the boards, when they're overseeing these companies, we want to see them get really involved strongly and raise any ESG issues, and also report back to the limited partners on any issues that may be happening with the portfolio companies.
Thank you for those comments, Richard. And I guess at this point, Leonard Green may have a stellar ESG policy, but we think we need to just kind of look carefully at some of the decisions that they've made about reinvesting dividends into their properties, and especially in this time where those kinds of medical access is critical for certain populations that are being hit hard by this pandemic. So thank you for those questions, Member Romero. Anything further before we move on to 5B?
Madam Chair, this is Harold. I had posed this question to Charlie, and I'll pose it back to Carrie and Charlie. As you know, we all have to do a financial report. I don't want to be Larry Barker's poster child again, as I was in 2011 when I joined the council, because I hadn't turned in my financial disclosure report. The process may not be as intuitive as it might have seemed it was possible for it to be. And so with Carrie's help, I went through the process and ultimately got it to the point where it said that I would receive an email with my logon name and password so that I could submit the report. I haven't heard a thing. This is the 26th. If I understand correctly, it's due either the 30th or the 31st. So I'd like to suggest that maybe we can do a little bit of research so that we can be alerted as to exactly what we need to do. Thanks.
So Member Lavender, I actually can share my own experience in this because I had to undergo the disclosure not only as a council member, but also as an elected. And basically what we did was send just a follow-up email to the Secretary of State indicating I've registered but have not received my my credentialing email, and they responded within the day.
I wonder if it might be possible for Charlie or Carrie to let them know that this is the case for the council, at least, unless others have gotten theirs. And then maybe we can, rather than each of us having to call and for typically the interminable hold, we could be done as a group. That's just a suggestion.
This is Mike Messina, Madam Chair. I haven't received anything and would very much appreciate getting the copy of the form so I can comply.
Yeah, and it's done online this year, Member Messina. So Steve, could we have just sort of a general inquiry on behalf of council members to the Secretary of State?
We will be glad to do that, Madam Chair. Carrie knows how to navigate this process as well as any of us. I had similar issues. Carrie, would you be kind enough to follow up on this?
I certainly will. I didn't realize that other people, Steve, you had the same situation where you didn't get your email with a username. So I didn't realize that other people had the same problem. So I will follow up. I actually have a name there, so I'll follow up with her this afternoon.
Thank you, Carrie.
Thank you very much, Madam Chair.
Yeah, thank you for that, Member Lavender. Okay, so with that, we'll go to agenda item 5B. Our next SIC meeting is next month, Tuesday, February 23rd. I believe probably still held telephonically at this point, unless there's anything that you've heard differently, Steve.
We have not.
Okay, then we're going to move to agenda item 6, which is public comment. And I'm going to turn it over to Charlie Bowman to give us what public comment has been submitted to the SIC for today's meeting.
Thank you, Madam Chair. I have one short public comment that comes from Daniel Pritchard of Renewable House. Greetings. A couple months ago, he wrote, I advocated with some members of the SIC for the establishment of a baseline report on all SIC renewable energy investments. This baseline report would be very useful when implementing metrics to measure performance and meet the renewable energy investment strategic plan, which is now in place. It seems this data would be easy to collect from all the fund managers. One would expect they know how they've invested in renewable energy. Please comment on the creation of a report telling the citizens of New Mexico exactly how much is invested in renewable energy today across the SIC's portfolio. Thank you. End of message.
That is the only public comment, Charlie?
Yes, it is, Madam Chair.
Okay, so Mr. Pritchard, I agree. I think that's a great recommendation. So we'll follow up on that and see how easy or difficult it is to get a baseline on how much investment we have from the SIC portfolio into renewable energy investment. So thank you for that public comment. With that, we are on agenda item 7. Do I have a motion to adjourn?
It's Harold, so moved.
Mike, wait, I have one thing to bring up, please. This is Mike Messina.
Okay, Member Messina, hold that motion, Member Lavender. Member Messina.
Yes, thank you, Madam Chair. Thank you, Harold, for holding off. I just wanted to mention the investment committee is now down to 2 people. We had been at 3. So if anybody's interested in joining that, I think it would be helpful. I just wanted to call that to members' attention.
Thank you, Member Messina. And with that, we've got a motion from Member Lavender for adjournment.
Second.
And we've got a second, I believe, from Member Frank. Any objection to an adjournment motion? All right. Thank you, folks. We are adjourned. See you.
Bye, everybody. Bye-bye.